Please welcome Semafor co-founder and CEO, Justin B. Smith.
Good morning, everybody. Welcome. Welcome to the Gallup Hall and the second day of the Semafor World Economy Summit. I'm Justin Smith. I'm the co-founder and CEO of Semafor, which I'm proud to say is the world's fastest growing global independent news brand. So welcome to our home at Gallup. Jim Clifton, chairman and owner of this building and host, actually invited Semafor in here about 18 months ago, and so we are always his guest, and we're always so grateful for being here. Semafor, I started Semafor with my co-founder, Ben Smith, and a remarkable team of journalists and business people across the US, in Europe, Africa. We'll soon be launching a Middle East edition. Our mission was to build a global news property that would provide leaders around the world with intelligent, independent, and most importantly, transparent information to try to fight some of the well-documented ills in the news industry around bias, polarization, and information overload. In 1 year, we've established an audience of 5 million monthly readers, almost 700,000 subscriptions, and a thriving live events business like this one across the world. This event we began actually before our launch in October 2022, and our insight was very simple, that Washington, D.C. did not have on its calendar an annual public-facing media platform for global economy and business leaders. The annual spring meetings of the IMF World Bank convened this group of people this week, but primarily in off-the-record, closed-door sessions inaccessible to the public. So this week, we launched the second annual World Economy Summit with 100-plus speakers, 3,000 registered delegates, and a gala that we had at the Mellon Auditorium last night. It's really designed to be live journalism at its best, where Semafor's team of editors and seasoned journalists interview many of the world's most important newsmakers on the record. Independent quality journalism like this is expensive and would not be possible without the support of some fantastic partners. And so we've been working with 5 companies, Amazon, BCG, Hyundai Motor Company, and Verizon and Bank of America. And in particular, this morning's track on global finance is brought to us by Bank of America. So we're very grateful for your support. So with that, this session coming up is the one that I've been most looking forward to, which is the 2 co-chairs of the World Economy Summit, 2 of America's leading figures in business, public sector, philanthropy, and more. Our co-chairs, Penny Pritzker and David Rubenstein. Thank you. Enjoy the day.
David, why don't you sit there? So first of all, Justin, thanks for having us. David and I are really pleased to be able to co-chair. We're not exactly sure what we're doing as co-chairs, but we're happy to support everything that Semafor is doing. And it's my pleasure to interview someone who I deeply admire and respect, David Rubenstein. You know, he's the newest ball boy, owner of the Baltimore Orioles. But in all seriousness, I think David is the Cal Ripken or the Hall of Famer in whatever he takes on. And so whether it's philanthropy, investing, business, a TV interviewer, he is the best interviewer I've ever met. So it's really intimidating for me to be up here to ask him questions, and now in Major League Baseball. And David, you know, I'm really interested, and I'm sure the group here is, you know, why'd you buy the Orioles? For the glory of being a Major League Baseball owner? Or is it about your hometown?
Well, as many of you know, I grew up in Baltimore. I'm the only child of blue-collar parents. And I didn't have a lot of money, so I went to public schools, which were great schools, and I got a very good public education. And I've always was interested in baseball. I played the Little League baseball. I was an all-star when I was 11, but 12 I peaked. And I thought if you were a Jewish shortstop in the Little League baseball, you were certainly to go to the major leagues, but it turned out that wasn't the case. So my athletic career was stunted. To be very serious, I've tried in recent years to kind of give back to the country through some of my philanthropy, but I've called patriotic philanthropy. But when I thought back recently, Baltimore gave me a public education, public school education, and enabled me to go to a good college and then later a good law school. And I thought I owed something to Baltimore. Maybe I hadn't given enough back to Baltimore. There was an opportunity to buy the team when I think there were many people in Baltimore felt that the team needed perhaps a change. And so the owner was prepared to sell. And so I negotiated the deal with some others, and we did it. The team is in pretty good shape. I can't take any credit for it. But I really saw it as a way to give back to Baltimore a bit for my good fortune having grown up there and gotten a public education there. My parents were born there. My parents were married there. My parents raised me there. My parents are buried there. I was raised there, educated there, and I will no doubt be buried there as well. So I figured it's a good place to kind of do something for. So, thank you. Thank you.
That's the David Rubenstein I know, and I'm so glad you shared that with all of us. Thank you. So David, switching a little bit to the economy and business, you nightly you dine with the best and the brightest in business. What are your biggest concerns and opportunities you hear about from investors and executives, behind closed doors, if you would share some thoughts?
With respect to the economy, the biggest concerns that I have and others share is that a couple of things. One, the U.S. government does not operate as efficiently as we might like it. And the Congress is split, obviously divided between reds and blues, Republicans and Democrats. So it has a hard time passing a debt limit bill or bills for aiding Ukraine or Israel. Very difficult environment. And so it's hard to think that this is a wonderful way to run a government. So in many ways, the biggest geopolitical problem we face is our own dysfunction in the way their government operates. Second is that we have a lot of debt. And this country, when the country started, we had $70 million of debt. When I left the White House under President Carter, we had about $800 billion of debt. We now have about roughly $35 trillion. And nobody seems to be worried about it that much, in part because people are willing to buy our treasury bills. At some point, people won't be willing to do that. The Dutch guilder was the reserve currency in the 1700s for the Western world. 1800s and much of the 1900s, it was the British sterling or pound. And then ultimately what happens is when you have the reserve currency and you own the reserve currency of the world, you tend to borrow money because it's easy to borrow. And eventually your currency is devalued and people don't want to have your currency anymore. At this point, we have the only reserve currency in the world. We can borrow pretty much whatever we want at reasonable interest rates. At some point, people will say, I don't really want the dollar so much, and I think it's a problem because if we can't sell our dollars, we won't be able to pay off our debt. And right now, the interest on our debt is approaching the level of our defense spending. So we have a budget that's a big problem, and that's a big challenge as well. And the third problem I'd mention is that the United States is still the dominant economy in the world, but it's not inevitable that it will remain that way. And so all of us have benefited from the U.S. economy being pretty robust over the last 50 years or so. We've been the biggest economy in the world since 1870. We've been the dominant economy in the world since roughly after World War II. We were 50% of the world's GDP after World War II, and now we're about 18% and going down a bit. Whether we can sustain our lifestyle and all of our aspirations, if the dollar is devalued a bit, we can't pay our debt at some point as efficiently as we like, and whether we have the ability to have a government that operates in an efficient way. Those are the challenges we have.
Do you, David, looking out from the United States and think about the geopolitical tensions in the world, whether it's Israel, Ukraine, Taiwan, how's this affecting the economy? How's it affecting the world? How do you see that as an influence on some of the things you just mentioned?
Well, the U.S. economy is still the one that people want to invest in more than any other economy in the world. So we still have enormous amounts of foreign direct investment here. And we still have people coming here. We have 48 million immigrants in this country. 48 million. No other country in the world has more than 5 or 6 million immigrants. We have 48 million people who have come here in part because of the American dream, because of the opportunity to rise up by the dint of your own hard work and so forth. So it's still the best place to build a business. The entrepreneurial instincts of this country are legendary. And you think about this. How many of you can get through the day without an American technology that you didn't have when you were a kid? So right now, everybody's day depends on either using some Amazon product, Microsoft product, Facebook product, Google product, Apple, and so forth. These are all American technologies. Europe is has 200 million more people than we do. 200 million more people than we do. There are no European technologies that any of you need to get through the day. Why is that? Well, for a number of reasons, Europeans didn't invent technologies that we now feel are essential. So American technology has dominated the world in a way we couldn't have anticipated even 50 years ago, or even 25 years ago. So I think this is an incredible testament to our entrepreneurial spirits, our really talented people, the great universities that produce a lot of these people. Whether we can continue to that, I don't know. But the biggest challenges, I think, overseas for us is we had, after World War II, we had a bipolar world, the Soviet Union and us. Then for a while, after the Soviet Union, the Berlin Wall fell, we had basically a unipolar world. Basically, we dominated the world in almost every aspect, everything. Now we have China, and with India, but certainly China is a rival in technology, military, geopolitical kinds of things. And we have to figure out how to deal with that and still continue to grow our economy. I think I would rather invest in the U.S. economy over the next 10 or 20 years or so than the Chinese economy. But I think it's not without challenge. We will have some challenges, and we have to get used to the fact that we have a government that doesn't work so well. We have a lot of debt, and we have income inequality that is growing, not shrinking, and we have a social mobility that is worse than the income inequality. Social mobility means not just income inequality, but the ability of people on the bottom to rise to the top. But people who believe in the American dream generally are people who come from outside the United States, and they come here. People born in the bottom of the socioeconomic structure in this country, very often minorities, they've given up on the American dream, and very often they turn to other kinds of pursuits that are not productive. And as a result, we have an underclass in this country, and the question is, can you really have a two-class society perpetually where the underclass has no chance of getting into the middle class or upper class? And that's a big challenge for us.
What do you think about what's the role of education in trying to break that barrier?
Education is the greatest opportunity that anybody has to better themselves. My parents didn't graduate from college or high school. And if I hadn't gotten a good education in Baltimore and later in college and in law school, I would be, part of the underclass, no doubt, doing the same kind of things my father did. And he was a blue-collar worker his whole life, made virtually no money. Education is the thing you can take wherever you go. Once you've got your brain filled with something that enables it to function well, you can live anywhere. You don't have to worry about your material possessions. You can always make more money again if you care about money or do something useful for society. And so education is the key to success. And there are always going to be Bill Gates kind of person who drops out of college, or Mark Zuckerberg, but you're not going to most likely be Bill Gates or Mark Zuckerberg. Get a good college education. You can't get too much education. And I think to me, the American higher education system, and you're the senior fellow at Harvard, and
you're the chair of University of Chicago, and before that, chair of Duke. So
to me, education is one of our great national assets. When we can, our colleges and universities are not perfect. I can criticize them all day, and I know what all the mistakes are and the failures. But on the whole, what we have now is an education system that is the higher education system, the envy of the world. K-12 is not the envy of the world, but the higher education system is the envy of the world. People come from all over the world to come to get our college degrees, PhDs, MDs, so forth. And we cannot let this system fall apart, because this is really the key to our country going forward. It's like a great education system we have that produces entrepreneurs, business leaders, cultural leaders, and we need to make sure that that continues. That's the most important thing, is making certain our education system is not degraded for political reasons.
Okay, switching back to the economy and the Fed, it seems like rate cuts are further off, that inflation's still a challenge, and higher for longer may be a reality. Does it matter?
Well, what it shows is John Kenneth Galbraith was a famous economist at Harvard, and he said, the conventional wisdom in Washington is almost always wrong. So, and he was right. The conventional wisdom in Washington 4 months ago was the Fed is going to have rate cuts probably 2 or 3 before the election. And I said the Fed will want to get its rate cuts out of the way before the presidential election gets into full steam because they don't want to be criticized for having rate cuts that would presumably help Biden. Now it looks like we're all wrong. The conventional wisdom today is rate cuts will probably be postponed until after the presidential election, or certainly later than we once thought, because inflation turned out to be a little bit more resilient than we thought. But I think rate cuts are likely to happen, but I don't think that the world feels they have to happen right now. Take the U.S. economy. We grew last year at about roughly 3%. This year, we're projected to grow something to 2.7%. That is twice the growth rate of any country in Europe. In fact, twice the growth rate of any developed country in the world. So we are doing pretty well with even relatively high interest rates. So there's not a compelling need to lower interest rates right now, given the way the economy is going and the fact that unemployment rate is still so low. So I don't think the Fed feels, I can't speak for the Fed, but I don't think the Fed feels they have to have interest rates cut right now in order to help the economy move forward. The economy is doing pretty well right now.
All right, so on the interview circuit, who's your favorite interview subject, and who's dodging you that you're trying to get?
Well, you.
No.
I would say I am doing a book on the presidency and coming out in September, and I did interview Joe Biden recently. I spent time in the Oval Office alone with him, interviewing him, and that was interesting. And I had a meeting with Donald Trump recently, and he said he would let me do an interview with him. It hasn't been scheduled yet, but hopefully soon. And I've interviewed a lot of people that I thought were really impressive and are complicated in some ways. My interview with Elon Musk was complicated. He's not an easy person to interview. One of my favorite interviews was with Jeff Bezos. Jeff has a great sense of humor, and I did it in front of a couple thousand people. And when you have a large audience, you can play against the audience. So when I interviewed Bill Gates once in his office, I said, Bill, do you really think that you could have been more successful in life if you'd actually had a college degree? And it kind of went over his head. He didn't get the joke. But if you have and he gave a serious answer. But if you interview him in front of people, then he gets then they laugh, then he realizes it's a kind of a joke. And so the best question I ever asked him was, Bill, tell me, why do I have to have 3 fingers to turn my computer on? Control, Alt, Delete. Where does that come from? Why did you do that? And he kind of thought about it, gave a long explanation. He said, in the end, we made a mistake. We didn't need to do that. But actually, the reason he did it was because they wanted to make sure your computer didn't go on accidentally by brushing against a button or something. And so they had to make it complicated to get on. But he said they could have done it a different way. I interviewed George W. Bush and Bill Clinton together. And, interviewing 2 presidents together is complicated. And I said to them, what do you guys say when you get together? Former presidents of the United States, what do you say to each other in the back in the green room? You talk about presidential affairs, you talk about all kinds of international things. He said, no, George Bush said, what we talk about is this. When is this event going to start and when's it going to be over? That was what they talked about. And then finally, I interviewed Oprah, who's a great interviewer, and she said, no, I'm not really a great interviewer. I'm a great listener. The key to being an interviewer and doing it well is listening to what a person says and pivot and so forth. So the reason I like doing it is, and I stumbled into it, wasn't something I chose to do, thinking about it in advance, is that when you get to be a certain age, you always worry, is your gray matter evaporating quicker than you would like? So I am now at an age that, people didn't think you'd live this long years ago. When the Social Security system was set up, the average American lived to 65. Now I'm 74. An age that too young to be president, but still a good age. But you always wonder whether your gray matter is going to evaporate. And one of the ways, if you have a certain predisposition, there's not much you can do about it, and you have certain things in your brain, you can't maybe change it. But there are some things you can do to maybe thwart or slow down the aging process in the brain. And so one of them is learning a foreign language. I have no skill there. Learning a musical instrument, absolutely no skill either. There, doing crossword puzzles, not good at that either. So I thought, what can I do? So when you do an interview, as you know, you prepare, you have to spar with the person, you have to listen to what they're saying. So I kind of do it to keep my gray matter alive, and I enjoy doing it, and we'll keep doing it for a while.
Well, with that, let me say this is a great person to listen to. And David, a great admiration.
All right,
for
thank you very much, Penny. Thanks very much. Thank you.
Please welcome John Williams, President and CEO of the Federal Reserve Bank of New York, and Semafor Senior Editor Gina Chon.
Good morning, everyone. I did not know that David was so funny. We'll see if John can bring the jokes. Oh, no pressure. So obviously, we're here when a lot of central bank governors, a lot of finance ministers are in town, and the Fed is the talk of the town. You have an important role as a permanent member of the Fed rate setting committee. We just heard Jay Powell throw some cold water on the idea that the Fed could possibly cut rates later this year as it had projected earlier. Are we in a higher for longer, really mean it this time stage where we could see this pushed off to next year?
Well, first of all, I mean, we always say that we're data dependent, and the data have been really pretty good on the economy. We just, you heard David talk about that. We added 3 million jobs last year. Job growth still has been very strong coming into the first quarter of this year. GDP growth's been strong. All the signs of our consumer spending is strong. So we have a strong economy. We want a strong economy. That's all very good news. But it also means that the rates that we have haven't caused the economy to slow too much. It seems like monetary policy is working the way I think we hoped it would. We're seeing imbalances in the economy come down. We're seeing the tightness of the labor market become less over time. We're seeing inflation come down, and we're seeing wage growth come down. So monetary policy is in a good place. I think we've got interest rates in a place that is moving us gradually to our goals. So I definitely don't feel urgency to cut interest rates. I think that monetary policy is doing exactly what we'd like to see. Over time, the data will inform kind of our decisions. I think eventually, my expectation is as inflation gets all the way to 2% on a sustained basis, as the economy is in good balance, interest rates will need to be lower at some point. But the timing of that's driven by the economy. The economic data, like I said, are strong on the labor market and GDP and spending. And on inflation, it's a little bit of a bumpy road, but overall the trend is the inflation has gradually coming down.
Well, is there a possibility that the U.S. economy is so hot that the Fed would consider actually raising rates? Because we've seen the recent retail spending numbers were stronger than expected. You talked about the jobs market. The last jobs number was kind of a blowout compared to what the expectations were, and we're seeing inflation not tick down in the way that the Fed had hoped for. And consumers seem to be feeling better, actually, where consumer sentiment had been the lagging factor, but now that seems to be getting better as well. So is there a possibility the Fed could even raise rates?
Well, it's not my baseline. My expectation right now is that interest rates are in a good place, and eventually at some point would want to lower interest rates as the economy really gets to the 2% inflation that we're headed towards. Of course, you never know what can happen if if the data are telling us that we would need higher interest rates to achieve our goals. Then we would obviously want to do that. So it's not my base case, but one of the things we've learned over the past few years is it's hard to predict the future, and we need to adjust our policy stance as appropriate to achieve our goals. I think one thing that's really important in this is that when you hear 3% growth, and you hear 3 million jobs or 275,000 jobs a month that we've been seeing the first part of this year, it's in the context of a supply side of the economy that is really strong. We're seeing really strong labor force growth. We're seeing really good productivity growth. So these 3% numbers, I think, are driven in large part by strong supply and strong demand. That's why we can see these strong numbers, and at the same time, the unemployment rate is relatively flat at 3.8%, and we're seeing the imbalances in the labor market actually recede, not get tighter. So this is a really more of a supply-driven, I would say, expansion right now, and for monetary policy, it's not, we just need to make sure that demand and supply are in balance.
Yeah, well, and talking about not being able to predict the future, you talked about getting to that 2% target for years, the Fed had undershot that target, and now it's sort of overshooting it. We saw former Fed Chair Ben Bernanke do a major review of the Bank of England and its inflation modeling tools and forecasting tools, and basically now they've called for a major overhaul. Bernanke sort of detailed some of the failings. You know, we obviously heard Fed Chair Powell walk back the whole, transitory language, and maybe there was a better way to describe it in the past. Do you think that the Fed also needs a similar sort of post-mortem review?
Well, first of all, I thought the former Chairman Bernanke's report for the Bank of England was very good, and I think made a lot of really important points. I think some of those points, I think we at the Fed very much take to heart already. We need to constantly make sure we have the best economists, best analysts, the newest models, the newest data. The data we use at the Fed today is dramatically different than the data of the past. Obviously, we look at GDP and unemployment and that, but now we have all this granular, high-frequency data from the various different suppliers of data that's telling us what's happening in much finer detail, much quicker. So it's not nearly as backward looking, and we're able to do that. And that's something that we've embraced. I also think an important point that Ben Bernanke made was the importance of clear communication and transparency in monetary policy making. This is something that in my career, the Fed, the Fed has moved from being somewhat opaque to more and more transparent and clear, not only in setting our 2% inflation goal, explaining how we think about the economy, giving our projections and the dot plots and all that to help as best as we can for the public to see how we're thinking, what's driving our decisions, and basically hopefully align the public's expectations with what we're trying to do. I think those have been hugely beneficial to us. These are things that former Chairman Bernanke mentioned in his report, and I think things that that we've been doing that have been very helpful. Down the road, obviously, my view is as we get through this episode of the high inflation from the pandemic, Russia's war in Ukraine, and everything that's happened, obviously we are looking carefully at our models, our analysis, the kind of conclusions we draw from that. And I think that assessment will, I think, be best done once this episode is kind of over, which I'm talking about, in the next year or two, because then I think we'll get the full picture. If you had asked me 2 years ago, what were the lessons of the pandemic and the war and everything, I think the answers we would have gotten would be incomplete and I would say somewhat misleading. Now we've seen inflation come down pretty quickly around the world, in Europe and Canada, in South America, everywhere. We're seeing a very different dynamic. Let's see how that plays out, and then we will, very carefully continue to study and what are the lessons and how we can get better.
Well, are there any sort of sacred cows, if you will, at the Fed? Like you mentioned the dot plot, which was, in itself a sort of innovation after the crisis. Larry Summers mentioned yesterday that maybe the Fed shouldn't give so much forward guidance, that maybe messaging to the markets as often as you do after FOMC meetings, at hearings and that sort of thing, that maybe that's too much communication, that there's some things that should be communicated sort of more conservatively.
Well, clearly communicating something like monetary policy, which depends on, billions of people in around the world and the economy and everything that happens, is always going to be challenging, no matter what the situation is. My personal view, I'm speaking for myself here, is that transparency has helped us. Doing things like providing multi-year projections, the chair's press conferences after meetings, these are helping people understand whether we make the right decision or not. They're understanding the reason, the inputs that went into that, and obviously we have to then adjust as the data come in and revisit our decisions every meeting and move forward. So I personally think the transparency has been helpful. We've seen inflation expectations, for example, basically around our 2% long-run goal before the pandemic. We got hit by the biggest shocks that we've experienced in generations. Let's be clear about this. These are the biggest shocks around the world that we've seen in generations. And we did see inflation inflation go up a lot, far too high. We saw inflation expectations move up. But as we and other central banks around the world took very strong, decisive action, inflation is coming back down. It's not all the way there. We still have work to do. But inflation expectations came down very quickly. So I think that the clear communication about our goals, about what we're thinking, and how we're viewing the economy has actually helped make monetary policy more effective. In this period, there were times where you could look back and say, would you make a decision differently, or would you have communicated a decision differently? Absolutely. If you can go back in the past and change things, there's a lot of things I would probably change in my life. But I think that from the point of view of being effective, I think the transparency has been a big positive.
And what about the 2% goal itself? Should that be revisited, and is that something that would require global central bankers, because it had been, basically a global goal of major monetary policymakers?
So I have a one-word answer to that, and that's no. I think 2% inflation goal is the right one. I think this is, a lot of people ask me over the years, well, where did that 2% come from? Did you pull it out of a hat? No, that came out of years and years of experience with countries around the world, years of very careful analysis about the pros and cons of inflation. And if you have inflation, you push it too low, you run into issues of hitting the lower bound or deflation, and that's not good. If it's too high, that causes bad effects on the economy. I think the 2% inflation target has served us very well. Other countries have similar goals. Of course, they slightly different goals depending on the jurisdiction, and that makes sense. But I think for us, the 2% goal is really important. We have to not only have that goal, but we have to importantly achieve that and reinforce that credibility. One thing people, as someone who's an academic economist in my background, it's easy to write papers and analyze at conferences and things and debates about, do people really care if inflation is a little higher? And then you go and look at what happened the last few years. There wasn't anyone here in the United States or pretty much any other country I know of that thought 7% inflation was a good thing, or 6%, or 5%. It's clear that low inflation is the bedrock of prosperity. Stable price stability is absolutely essential. So you can theoretically you can think about these things. In the real world, I think we need to have a low, stable inflation rate.
And I wanted to ask you about what's a bit of the elephant in the room during a lot of the meetings here is the prospect of another Trump presidency and what that means for the Fed in terms of its independence, its resiliency as an institution. We had seen Trump, when he was in office, call Fed Chair Jay Powell an enemy of the people, pressuring him to lower interest rates. Do you think that the Fed is up for possibly a round two, and are you worried about the Fed as an institution?
I'm not worried about the Fed as an institution personally. I've been in the Fed now nearly 30 years. I've been on the FOMC 13 years. We are a group of people who get together and we focus on one thing, and that's the economy. That's achieving our maximum employment and price stability goals. The world happens around us. Of course, in Washington, D.C., there's politics, not just in election years and any time. But we have a very clear mandate around monetary policy. We focus on that. You can read the transcripts. They come out 5 years later. If you, especially if you're having trouble sleeping, you can see that we spend 8 hours.
That's a good Fed joke.
Yeah, that's a Fed joke. Yeah, it's like a dad joke. We spend 8 hours talking about the data in all of its details. And there's a wide range of views and disagreements. The wide range of views and disagreements are about how do we best achieve our goals. And there's a commitment to both our 2% inflation goal, our maximum employment goal, and really it's just getting that done. What's the best way to ensure independence of any central bank? And that's to do our jobs well and focus on that.
But are you worried about any challenges where they've been talking, possibly some of his advisors, about ways to lower the value of the dollar to make our exports cheaper, things that would just throw some obstacles in the Fed's way?
Well, I'm not going to speculate on any hypotheticals at all around any of
Some
those.
currency manipulation
I'm not going
tactics.
to engage in that. Again, the value of the dollar, that's the domain of the administration, the U.S. Treasury. Again, we're focused on monetary policy.
Sure. Well, and I know we're out of time. I just want to ask you really quickly, as you look forward, what are the things that you're keeping your eyes on that will help sort of influence your views on what the Fed should do going forward?
I think one big question is this supply side thing. We've seen this big increase in the labor force. We've seen very good productivity growth. Again, roll back the clock 2 years ago, there were a lot of concerns that the U.S. economy wouldn't get back on track with the pandemic and everything. And we are back on the growth track that we saw before the pandemic when you look at the overall economy. So watching, if that continues, I mean, that's a very positive development for real incomes, for growth, and also for bringing inflation down. So that's one thing I'm very focused on. The second, clearly, is China. What happens in terms of their economy, their efforts to keep their growth near their target level, and especially, given what's happened in real estate in China there. So that's something that I'm very focused on. And I think the third is the most important lesson, again, of my 13 years in the FOMC is expect the unexpected. The last 5 or 6 years, we've learned really the importance of planning and preparation and being nimble and agile and how you see what could happen, being prepared for things you didn't expect, not being kind of locked into a certain view, but really come into any situation thinking things can develop very differently and being able to adjust to that. So those are the things that I'm focused on.
Great. Well, we'll have you back again to see how all of that plays out. Thank you so much, John.
Thank you.
I'm going to have to stay on stage, listen, so thank you.
Please welcome Sim Shabalala, CEO of Standard Bank, joining us remotely. Gina Chan remains on stage for this conversation.
Hi, Sim. Good to see you.
Good afternoon, Gina. Very wonderful to see you from a very warm Johannesburg. We are at 73.5 degrees Fahrenheit.
Oh,
Eat your heart out.
Thank you for the weather report. I think hopefully it will get up to here in DC as well. I wanted to start off maybe on, I guess, a less sunny topic, just on geopolitical tensions. You run the largest bank in Africa by asset size. We've seen, obviously, a lot of issues in the last few years in terms of the war in Ukraine, growing US-China tensions, and most recently what we've seen in the Middle East. And a lot of times countries in Africa are buffeted by these world events. And I just wanted to get a sense from you how you are seeing this play out for your bank, for the African economy, and for the South African economy.
Thank you ever so much for that question. I think the place to start is by reflecting on the Thucydides trap. If you recall, Thucydides wrote a famous book on the Peloponnesian War, which was a war which occurred roughly 431 BC, where there was a rising power, Athens, and there was a established power, Sparta. And the war occurred as a consequence of a fear and of the rise of Athens in the hearts, I guess, of the leadership of Sparta. Harvard academics have written extensively on the issue and have analyzed 16 wars that have happened in the last 500 years, or 16 Thucydides traps, in fact. Of those 16, 12 resulted in war. And I think everybody at the moment is seized with this issue. Are the events that are unfolding currently likely to result in a Thucydides trap? We, like everybody else, do scenario planning, and we're thinking through what the implications of a conflict between China and the United States would be. I have to say, from our perspective, we think a war between the United States and China is improbable. It's possible, but it's improbable. Some of the data points would point to is the recent visit by Secretary Yellen to China. the visit by US businessmen to China, the opening of conversations between the US military and China. Of course, there are worrying issues and worrying trends, particularly around the South China Seas. We've seen developments in Australia, with the Australians also being very concerned about the prospect of a hot war. In all of this, our approach is also to say, having regard to all of those scenarios, we would advocate for African governments and African businesses retaining their independence and retaining their neutrality and looking after the best interests of Africans, not taking sides, but of course, there is always the risk that they be forced to take sides. Indeed, in that context, if I may close on this point, there are vast opportunities arising from all of this. Sure, there are risks and there are concerns. Higher oil prices, but higher oil prices would also, for some of our countries, generate better revenues for them. A reduction in commodity prices, opportunities for other commodity producers on the African continent. We think that there is going to be continued need for the transition, regardless of what happens in this conflict. Africa produces all the minerals necessary for a green transition. We have the world's lungs, and we ought to be positioning ourselves on the African continent to take advantage of this transition. There's going to be a dislocation in manufacturing, and African countries should be positioning themselves to take advantage of that dislocation in manufacturing. So yes, massive risks, but I would say also vast opportunities.
Yeah, I wanted to follow up on those opportunities. Are there ways that you could sort of play various sides off of each other in a way that is advantageous? We've seen the US and China try to curry favor with various governments in Africa because of their natural resources, because of possible military bases or other interests where they've never seen so many officials from the United States and China come pay them a visit. Are there ways that it could work to your favor?
Gina, I think the ethical principle in all of this is one that would insist on Africans looking after their best interests in exactly the same way as the EU does, the French with their strategic non-alignment, South Korea also taking a position of active non-alignment. In the case of Africans, they speak generally of active non-alignment. I don't think it's a case of playing people off against one another, but it's a case of looking after the best interests. If you're a country that is producing natural resources that the world needs, well, best you negotiate the best bargains at arm's length. If Chinese are interested in acquiring your resources, well, best you negotiate the best bargain for your nation. Americans see the African continent as a vast opportunity. There are opportunities to increase trade and investment. Africans ought to be encouraging that investment, but making sure that they're looking after the best interests of Africans. I think there is increased sophistication amongst African leaders and African business people. And it is a focus, not so much, as I say, on playing people off against one another, but on negotiating at arm's length the best bargains that are in the best interests of Africans.
And turning to South Africa, we're seeing a lot of major consequential elections taking place this year, including in your country in May. There has been 30 years of democracy there, but it's also still considered to be one of the most unequal societies in the world. And I wanted to get your take on how that affects the business environment, how that affects the investment environment, and what you think should be done to alleviate that.
100%. South Africa's got one of the highest Gini coefficients in the world. It's got a high unemployment rate, and it's got poverty and inequality that will make your heart break. But, however, it is currently the largest economy on the African continent at $400 billion. It's now larger than Egypt and Nigeria. It is an economy, however, that is slow. It's growing more slowly than the rest of the continent. Sub-Saharan Africa is billed to grow at roughly 4% this year. We calculate that the South African economy will grow at roughly 1.2%, a large base, but growing slowly. Yes, elections are coming up. Over a dozen countries on the continent are going to be going into elections, whether it be provincial or national elections. In the case of South Africa, our elections, as you say, are on the 29th of May. The concern from the economic sector, from investors, both domestic and global, is what policy implications will arise from these elections. The current ANC government is one which has exhibited high levels of orthodoxy in terms of its fiscal policies, its monetary policies, indeed industrial policy as well. Should they lose the elections, is there going to be a policy change? To what extent will they lose? Will they get to just below 50%? And what are the implications if they do? Our view, based on polls that have been taken and analyses by our political economists, is that there is roughly a 20% chance of the ANC, the ruling party, getting above 48%, in which case it may not need a coalition, in which case the current policy trajectory, the structural reforms happening continue apace. If it gets between 43 and 47%, we reckon that's a 50% chance. In that case, they would need a coalition with one of the mid-sized political parties, such as the IFP. If it gets below 43%, we think that's a 20% chance. Then they're likely to go into coalition with some of the larger parties, the two largest being the Democratic Alliance, which is right of center, and the Economic Freedom Fighters, which are left of center. There's a 20% chance of that happening. Which would it be of the two? Time will tell.
Sorry to interrupt you there. I wanted to kind of break down some of those coalitions, because if the ANC doesn't get enough votes and does have to form one of these coalitions, and as we've seen kind of happen around the world, are you worried that they will be forced to partner with a group that is a bit more extremist in their views, either on, the sort of populist leftist side or other ideologies that may force it to advocate policies that it normally wouldn't?
If they get above 48%, they will need a coalition with one of the smaller parties, in which case the policy trajectory that we've seen in the last few years continues. The structural reforms, electricity, transport, the network industries, that continues apace. If, however, they get between 43 and 47%, the likelihood is that they partner with the mid-sized parties, which are generally right of center. The one I made reference to is the IFP, which is very orthodox in its economic thinking and economic policies. The chances of that happening, we are attributing to roughly 60%. So it's the highest probability. If, however, they get below 43%, we think the probability of that is roughly 20%. It's a small probability. In that case, they could go into alliance and into coalition with the Economic Freedom Fighters, which, as you say, are populist, they're left of center. The probability, however, given trends in South Africa, is that they could go with a Democratic Alliance, which is orthodox, generally right of center. In either case, the thing I want to leave you with, Gina, is that South Africa has got very strong institutions. The Independent Electoral Commission, the judiciary, the business sector. The chances of people effecting populist policies, in our view, is small, because they will be disciplined by the institutions.
And in terms of the slow growth that you mentioned, whoever wins the elections, what are some of the economic policies that you want to see that you think could help stimulate that growth, bring more foreign investment, and attract investors in general?
First of all, reinforce the independence of the central bank and remind people that you require 2/3 majority in South Africa to change the constitution and therefore change the authority of the central bank. Our central bank is very independent. Secondly, reinforce all existing institutions such as the National Treasury. The National Treasury in South Africa is rated second in the world for budget transparency. And has been rated second to New Zealand in most instances for the last decade or so. So preserve the discipline in fiscal policy and preserve the independence and strength of that institution. Third, accelerate the structural reforms, the first one of which is power. The lack of power and the diminution of the generation and transmission of power in the country shaves off roughly 3% of trend growth. So the faster the country can effect structural reforms in electricity, the faster it will grow above 1.2%. As I said, we project 1.2% for 2024. The second one, which is another crimp on our GDP growth, is logistics. We need to accelerate the reform at Transnet, which is a logistics company, bring in partners in freight rail, continue the reduction in backlogs in our ports, particularly Durban Port and Cape Town. Thirdly, continue the rollout of spectrum. So there was a fantastic spectrum auction a year or two ago. Licenses were paid for by the telcos. They're now rolling out 5G. They are buying plant and machinery for the purposes of fiber and towers. Third, accelerate the diminution of corruption and crime in the country. Fourth, deal with the water challenges. Fifth, as a general proposition, Gina, accelerate the rebuilding and refreshing of public infrastructure in the country. Now, these are things that the existing government is committed to doing, but I would be arguing that they need to be done faster, at lower cost, and with greater speed.
Great. Well, we'll be checking back in with you then after the elections to see what you think is on tap. And I hope the weather stays nice there, Sim, and as we do here. Thank you so much for your time.
Thank you ever so much, Gina, and yes, thank you.
Please welcome President of Goldman Sachs John Waldren and Semafor Business and Finance Editor Liz Hoffman.
Hi, John.
Hi, Liz. Thank you for having me.
Thanks for coming. You've had a busy week. Voting with their capital, I think, is the subject of this. So, we've seen, I think, foreign investments into China at 30-year low. Money is moving all over the place. Talk to a lot of clients. Where are they going? Where are they leaving?
I think a lot of money is going to Japan. Japan is a very attractive.
Got a client somewhere.
Somebody like that. Japan is a very attractive place right now for foreign capital. There's a lot of movement in Japan. A lot of policy that looks quite interesting for investors. Obviously, the sort of end of YCC, incremental moves on corporate governance. There's going to be more activism. I think the policy of trying to push kind of lazy deposits, more into the markets where people can savers can get more yield, which will be good for fixed income products. So Japan is very active, and I think has been a big net recipient of the flows that have come out of China. I would say India, which is obviously showing enormous growth, and Modi's government has been on a very big campaign to attract foreign capital, and the United States. I think those are really the three markets that have been the beneficiaries of flows coming out of China.
Talked about Japan. I think actually like a really sort of underplayed success story over the last 10 years. You've seen a lot of those reforms really start to work. But we were actually talking to the German finance minister yesterday about exactly this sort of capital markets. A lot of places in the world incredibly reliant on banks. How do you build, I think Larry Fink was talking about this a couple weeks ago, how do you build those kind of American-style capital markets in other jurisdictions? I'm sure you'll be leading the way, but how do you do it?
Well, I think you need a strong underpinning in terms of having a market-based system. You need strong regulation, strong fundamental regulators that want to lay the groundwork and the foundation. You need to attract the foreign capital, so it's got to be a place where rule of law works, and there's a clear set of prescriptions where people know, how they're going to get their money in and how they're going to get their money out. Capital controls can be problematic. So one of the things I think really is a struggle in China is that
business and community was his approach to China. And now it's a little bit more of a bipartisan thing, but I think he was sort of more willing to call out anti-competitive behavior, currency manipulation. It feels like maybe that's table stakes now, but that just was one thing that I think, people in the business community really responded to.
Yeah. Well, one of the things I've been here most of the week, one of the things when you spend a week in Washington and you wander around both parties and spend time in the different...
You immediately try to get back to New York?
Well, no, I didn't say that. You said that, I didn't say that. You realize how bipartisan the hawkishness really is. It's not Trump or Biden or Biden's national security team or Trump's national security team. It's pretty built-in bipartisan hawkishness on China. I think it's dangerous because it's kind of hawkishness sometimes without a prescription for how we would execute upon a responsible relationship with China. But I agree. I think Trump kind of changed the narrative and changed the way we think about China, broadly. Now both parties are pretty, I think, firmly ensconced that we're going to be much tougher. And I think that will be, as you can see from the Biden administration, they're getting ever tougher. I think it's going to be a prescription from both parties. I don't think it's going to be one party or the other.
A ton of risk has moved off your balance sheet, off your competitors' balance sheets over the last 10 years and gone somewhere, places we can't totally see it, can't totally regulate it. Been a lot of debate about, I'm not going to call it the shadow banking system, but plenty of people do. How worried are you? Is there some reckoning, though, because we can't quite get our arms around it?
Well, here's some interesting stats. I think that the private credit market has grown at a 25% CAGR in the last 5 years, and the syndicated market has grown at like a 3% CAGR. And regional bank lending isn't growing very much at all. So you do have a significant shift in U.S. terms in credit extension that has gone into more private credit vehicles. Now, Goldman Sachs has big private credit vehicles and have for some time. We're not particularly worried about that or think that that's a bad thing. You could make the debate, and many do, that those structures are less levered. Typical bank would run at a 7, 8, 10 times levered balance sheet, and the private credit vehicles would be 1 to 1 or maybe 2 to 1 if you look at back leverage. So you can argue longer dated liabilities, not an asset liability mismatch, less leverage, doesn't have to be a systemic problem. But anytime you see that amount of growth, exponential growth in one area, you have to wonder about, I think, the quality of what that lending has been, how it looks, and what happens if we have a credit cycle. We haven't tested it yet, is the reality, and I do think the regulators, who tend to call it non-bank financial, intermediation. It's not shadow banking, but that's the NBFI would be the term. I think the regulators rightly are increasingly focused on, we don't really have visibility into it. We don't really understand the quality of it. I don't know that there's a massive concern that it's actually systemic. But if we have a credit cycle, which I think at some point we will uncover probably some things we don't like. And hopefully there's not more, kind of leverage on leverage that we don't really understand. That starts to unravel. So we spend a lot of time worrying about it, looking at it, thinking about it. There's nothing that we see inherently right now that's particularly concerning. But I do think if there's a credit cycle, we're going to find things that are unappealing.
I think you're kind of making three arguments. One is the stuff risky? So like the credit quality of these loans, we'll either know or we won't. One is it levered? Goldman in 2008 was probably 30 to 1, something like that. And then the third one, which I have a harder time getting my arms around, is it plugged into the system? Because to your point, a lot of long-dated liabilities, a lot of this is insurance money, which annuities money seems to have held through the rate cycle from a funding perspective. We haven't really
It's insurance money, it's pension money, it's traditional LP capital. So it's
less liquid, less of a run risk.
It's the same capital that's in private equity vehicles. It's really not that different. It might be a bit more insurance than it is in private equity because insurance tends to want to buy credit, not equity. But it's the same. If you look at the bigger pools of capital, it's the same kinds of LPs that you would find in a big private equity fund for the most part. And so, by the way, a lot of that is retail money, right? Because it's ultimately pensioners' money or insurance, contract money. So a lot of it does find its way into retail. I do think that this growth in retail, in private credit, is something that we should all be thoughtful about. Because the more you put money into retail hands, they think they're buying a yield product. And if we have a credit cycle, the yield product turns into cents on the dollar potentially. That's where I think there's some risk in the system, and that's where I think you could also get some regulatory response.
But all of private investment is trying to figure out how to crack retail. because there is a growing but limited pool of institutional capital in the world, and there's a lot of untapped retail money. How do you do that safely, understanding that, you tell people that things are liquid, that fundamentally aren't, and to try to sort of be both honest about what the product is, but also sort of understand that there's going to be a rush for the exit.
Well, the way we think about it is you have to be very transparent about what it is and what it isn't. It's not particularly liquid. Private credit is not a liquid, asset class. I mean, you're lending money, you're going to get it back in some years' time. So you have to be clear about the liquidity features. It's not like you're buying a public fixed income, portfolio. So if we're out talking to people, our clients about private credit, it's going to be positioned as an illiquid way to get alpha generation potentially in the context of your overall fixed income portfolio. And so I think the way that you speak about it, disclose it, narrate it is super important.
There's been some talk in recent years about trying to strike that balance between investor protection and wealth creation. A lot of the highest returning asset classes the last couple of years have been really off limits to most people, and you end up with, it sort of exacerbates the inequality. I'm not asking you to come up with a policy prescription, but how do you think about understanding that there are trade-offs for protecting retail investors from themselves?
Well, I think the most important thing is to think about suitability. I mean, there's alternative asset management has historically been an institutional product. I think it's like less than 1% of broad-based retail is really allocated to alternatives. We should debate the suitability, particularly in areas like private equity, which is also very illiquid and has higher, equity risk. How suitable is that for a retail investor? If we look at our private wealth network as an example, which is ultra high net worth, who are the wealthier people in the world, they can withstand more illiquidity and can be more invested in alternative assets, particularly private equity, private credit. But for the $500,000 person, the $1 million person, that's obviously harder, and the suitability issues are more pronounced. I do think that's why you see a lot of credit and infrastructure going into retail, because those are more yield products and they're less kind of equity risk. But again, you've just got to think about the illiquidity. To me, it's all about how much illiquidity can you suffer to get that sort of a yield and that sort of a return. And that's the trade-off that constantly needs to be judged. And I think suitability needs to be carefully thought through.
The former Goldman Sachs beat reporter in me would not let me get off the stage without, because we haven't had really a chance to talk about this, I don't think. Goldman, very publicly got into and they're very quickly out of consumer banking. And I'm curious, except for perhaps not doing it, if you were doing it, okay, was there something that you guys could have done differently where you think that would have worked? That was obviously a regulatory environment that was pushing you to white space to make the most of the regulations that you were tasked with. What went wrong there fundamentally?
Well, just remember why we did it. We came out of the financial crisis as a completely wholesale funder. And I think one of the real lessons learned in the financial crisis is if you're solely reliant on wholesale funding and there's that kind of a market disruption, you are really at risk in terms of losing your funding. And if you lose your funding as a bank, you don't have a business. So the whole notion was to build a deposit franchise. And to build a deposit franchise, you have to think about how am I going to build that franchise and what am I going to do to attract those deposits and what am I going to do with those deposits. And so I think it was a quite sensible plan that was architected back 13, 14, 15 to build a proper deposit franchise, which really has been a big success for the firm. We now have $110 or so billion of consumer deposits, which is giving us much more balanced funding. So we're in a much different place today than we were in 2007, 8, 9. And I think that's put the firm on a much firmer footing. What we then did is that we then went into the more consumer finance-oriented assets to utilize those deposits and try to build a really sizable consumer finance business. It's not really the Goldman Sachs DNA. I think we thought we could be competitive because we were a big bank that had big bank technology, brand, footprint capabilities, but we thought we could act and behave a bit more like a nimble fintech player, and we thought that those attributes would allow us to compete. It's an intensely competitive market. I think we learned that it's a lot harder than we thought it was. And frankly, when you look at what we're doing at Goldman Sachs, in our core businesses, I call it Goldman Sachs being Goldman Sachs, we're really good at those businesses. And we have more we can do with those businesses. And if you think about the resources are not infinite. Resources allocated towards things that we can do in investment banking, in global markets, and asset and wealth management are garnering higher returns where we have more comparative advantage and we can drive better results for our shareholders than trying to be another person in the consumer business. So we want that deposit franchise. We're nurturing that deposit franchise. I think you'll see us take that deposit franchise and marry it more with our wealth management business, which is a much better way for us to utilize those deposits, but also more aligned with what our comparative advantage is and what Goldman Sachs will be good at. And so the pivot to narrow the consumer ambition was really as much about focusing on the businesses where we have comparative advantage, where we can really drive returns. And as you saw with our first quarter results, we're doing well in those businesses. And I think we're going to continue to execute on the strategy of simplifying what Goldman Sachs will do and what we won't do, and really executing on the banking strategy, the market strategy, and particularly the asset and wealth management strategy, where we are really underpenetrated and have much lower share than we ought to have given the size and scope and capabilities of our franchise.
Okay, we're out of time. Thanks
Appreciate
for coming.
the time. Thanks for having me.
Please welcome Acting U.S. Labor Secretary Julie Su and Semafor co-founder and editor-in-chief Ben Smith.
Well, great to see you all here. Thanks for coming. And Secretary, thank you so much for joining us. We've been, like I was saying before, we've been kind of heavy on voices of capital this morning, so it's good to get a voice of labor here. And Secretary Su has operated at a very, very high level for many years because she was the her counterpart in California before this, which is an enforcement agency roughly the size of the Department of Labor, which she's now leading. Actually, I want to start asking about the politics of labor. When you poll people about unions, they're probably more popular than they've ever been. Gallup finds around 67%. And you see some Republicans reacting to that. Senator Josh Hawley walked a picket line. He voted to support tighter labor rules, which failed because two Democratic senators and independent voted the other way, Manchin and Sinema. And I wonder, do you see a world where we're starting to see two parties compete for labor support and union support?
Interesting. Well, first, thank you so much for having me. I would say that it is definitely true that we are in a moment where labor unions are enjoying more positive public opinion than in a very, very long time. And we see why, right? We came out of a global pandemic and the economic crises that accompanied it. And working people who were considered essential and valuable came out also saying, I actually want to be treated that way. I want to be valued that way. And unions in the last 3 years certainly have demonstrated that when you have a union on your side, you can enjoy really historic gains in the workplace. We've seen historic gains at the bargaining table, double-digit wage increases across from hospitality to healthcare to Hollywood, auto workers, delivery drivers.
We haven't seen, I think what you say sort of matches the vibes, it matches the headlines, it matches, as you say, some of what's happening at the bargaining table. The number of private sector workers in union still going down. What is that gap? Well,
so since 2021, 400,000 working people have joined a union in this country. I should also say that 65% of them are black workers.
And a lot of this is public sector, right?
It is public sector, but it's also private sector. And the percentage, it doesn't show up in the percentage as much because we have also been in a period of tremendous job growth overall, right? There's been 15.2 million jobs created since the president came into office. So the fraction, you've got a bigger denominator.
All right, don't too much.
Yeah, sorry, I might have said that wrong.
Wrong panel. You're losing me. But no, I understand what you mean. So the numbers, the raw numbers are growing, but in the context of a growing economy.
Are growing, that's right. And the gains are growing. And I think, as we've also seen, when unions lift up conditions in an industry, they also benefit non-union workers, right? We saw this after the UAW announced their contract, that non-union employers also raised wages. And so I think there is this moment in which people are really seeing the benefit to unions, not just for union members, but for workers generally. There's lots of examples of the benefit for employers in terms of stability, right? Stability in an industry, and certainly for our economy.
To go back to that question, are you seeing Republican support? Are you seeking Republican support? Are you having off-the-record conversations with Josh Hawley about this stuff?
No to the last question, but I think what's most interesting is the idea of like the public support really changing and companies stepping. So we've seen large and small companies agree to certain things like neutrality, right? This is sort of a basic concept that workers should get to choose whether they're going to join a union or not. That is the law, but oftentimes there are practices that companies engage in that deter workers from organizing. They are, retaliation, right? Captive audience meetings and the like. So we're seeing companies actually step up to the plate and say, we're not going to do that. And that's important too. And the other thing that is kind of what you're saying. I mean, we have certainly seen there are certain states in which there's been a tremendous hostility to union organizing. And, some of that is playing out right now as we speak. But there's also been some states that have kind of rolled back those so-called right-to-work laws. And so, I do think that it's a moment of change that is really important, and it's not happening by accident. It's happening because we also have a president who's been very clear about the value of unions in this country.
And now your role and your career, when you were labor commissioner and then labor secretary in California, have been a lot about enforcement, and the Department of Labor is primarily focused on enforcement. And I kind of wanted to run through a couple of, I think, what are the most significant issues. Beginning with, let's see, the gig worker question. I think when President Biden came in, there was I think a lot of people believe that we were going to see a crackdown on Uber and Lyft, a sense that these gig companies were going to have to pay minimum wage, that they were going to have to pay overtime. And you issued a regulation a couple of months ago making it harder for companies to classify workers as contractors. Are we going to see any action on that with the big gig companies this year?
So, let me say at the outset, because there's been a lot of news about this, that of course there's a role for independent contractors in our economy, right? They're an important part of our economy. When individuals, want to be their own, have their own business, that is something that is valuable in our economy. It will remain an important feature. Our rule is really about cracking down on misclassification, on employees who should be employees who are called something else in order to strip them of a century's worth of labor law protections, of minimum wage, of overtime, of the right to organize, of
So
right?
do Uber and Lyft drivers meet that qualification?
So the thing about the rule is that it is a fact-specific determination. We also didn't make it up. I mean, the rule is based on decades of federal case law interpreting the Fair Labor Standards Act. So that's what it is. It's applied to facts.
I think we all take Ubers. I mean, I think the facts of Uber and Lyft are pretty widely known. What do you think?
Well, it's also not an industry-wide test. Let me just be clear, right? I know it's, again, this is going against a whole lot of I think, news that is not completely accurate about this. So, but
so is the answer maybe on whether there will be action this year?
The answer is, yeah, the answer is, I mean, we are seeing action though, right? We're seeing action at the local level, right? We're seeing cities step up and say, these are workers that need to be protected.
But federal action from your agency?
So we will be doing enforcement around the Fair Labor Standards Act, and we are doing enforcement on misclassification. Where we are seeing it, just to say, is dishwashers in restaurants being called independent contractors, a construction worker on a construction site, a janitor cleaning a building. There's a lot of attention that's paid to one industry that I think obscures the real problem of what misclassification is causing.
Yeah, well, on another subject, summer's coming, and there's been a wave of regulation, I think notably in Florida. Governor DeSantis pushed through a law that, as I understand it, prevents municipalities from passing heat regulations, which has become a big issue that I wasn't that familiar with, been reading up on. But, rules that would say that you have to provide water, you have to provide shade for workers if the temperatures are a certain place. Is there a role for your agency in overriding that?
So there is a role for the federal government to put in place a national standard on heat. I mean, we all know this because we've all, lived through the last, certainly the last few years of record levels of heat, right? We don't even want to walk outside, much less go to work in a field or in a warehouse. So we are working on a national standard for heat. It would be the first ever, but it's important, right? Heat has become an occupational hazard, and we need workers to be kept safe. There's no reason why somebody should be collapsing and dying on a job.
What do you think of what Governor DeSantis did?
Well, I think it's problematic. I mean, I think it's a real problem, especially because obviously the states and localities are passing laws because they see the need in their communities. And so he's not the first governor to do it. Texas did it too. And soon after that, President Biden said, we're going to protect workers in this country because the federal law still applies, even if you...
Do you think the Texas and Florida laws are going to get people hurt?
Yeah, I think it is a mistake to take away standards that local governments, in their wisdom and in their knowledge about their communities, are putting in place to protect working people.
The third enforcement issue I wanted to ask about is disabled workers. There's been this stories, again, that don't always make big headlines, but there's a rule under which disabled workers can be paid like 20 cents an hour. There was a story of making handbags for the Oscars, actually. Is that something the Biden administration is going to change?
Yeah, that's important too. Thank you. So Section 14C allows for a sub-minimum wage for workers with disabilities. What I will say is, since that was put in place, there have been tremendous gains in the field of opportunity for workers with disabilities. We have the Americans with Disabilities Act. We have Supreme Court cases. We have something called competitive integrated employment, which many employers are utilizing to provide real equitable opportunities. That's where workers with disabilities are paid comparable wages to those without. That's when they're working, they get comparable benefits, where they work at the same location, where there's more interaction. There have been, again, real progress in valuing the contributions that workers with disabilities have. So on the 50th anniversary of the Rehabilitation Act, I asked my team to take a look at 14C just to make sure that it's kept up with the times. And this is related to the idea that we can build an economy where everybody benefits, where workers benefit and where all workers benefit, and where everyone has opportunity. And in order to do that, we have to make sure that opportunity doesn't depend on the zip code in which you were born, the circumstance of your birth, race, gender, sexuality, disability, all of that.
Now, I think one of the earlier interviews, Gina Chan, as I mentioned earlier, the interview moved the market, actually, some of the talk about interest rates. And I guess sort of wanted to give you an opportunity to do that. If Joe Biden is reelected, and I think it's totally plausible that there will be a Democratic trifecta. We don't know what's going to happen. What is sort of the most ambitious sort of dream package of labor enforcement and labor standards that we could see in a Biden second term?
My gosh, that's a good question. The president makes no secret of this, and I will say this because I do firmly believe that when we do right by working people in this country, it is better for everybody. And the last few years have really demonstrated it. Our economy has come back in a way, that others certainly have not. And part of that is because real wages have grown and there's a tight labor market. So I would say that this idea that we have to build an economy in which workers do well will continue to be a priority. And that's about continue to build a high road, right? Good jobs. I know you've spoken to some of my colleagues. The investments that we're making in this country right now to bring back manufacturing, to rebuild our roads and bridges, to make sure every family who turns on a faucet has clean drinking water, to make sure every community has high-speed, reliable internet. Those are important. They are not done overnight. So those will continue. Those are creating good jobs in communities across the country, and they are strengthening our supply chain, which I know you all are talking about and are part of that work. But you can't build that high road if you don't also combat the low road. So I appreciate that you talked about enforcement, because still there are too many workers in this country who go to work and don't know if they're going to come home healthy and safe at the end of the day. Child labor is on the rise. So we are seeing 13-year-olds working on the kill floor of a meatpacking plant. I mean, those are not okay. We're seeing young people doing roofing work. Not okay. There are laws that prohibit that, and they.
So you'd say enforcement in a second term rather than any kind of sweeping remaking of the structure of labor relations?
Well, look, I've never been in Congress, and we would not be Congress. There are. I believe both that there could be changes that are made to improve protections for workers. But I also believe, and I've said this to my team since I got here, that we have been given powers already, and we need to make sure that we are being smart and judicious and strategic about utilizing them in order to make sure that we breathe life into them. Laws are only as good as we make them real. So I really try to focus on the things that we can do by being smart, by working in partnership with industry, and that's sort of how I come to the position.
Secretary Sue, thank you so much for doing this.
Thank you so much for having me. It's really great. Thank you.
Please welcome remotely Senator Ron Wyden of Oregon, Chair of the Senate Finance Committee, joined on stage by Semafor's founding editor-at-large, Steve Clements.
Everybody, hopefully, Ron, are you there? Senator?
I'm there. Can you hear me?
Oh, great. I can hear you. Don't see her yet, but I'll let that happen. And by the way, if you get called for a vote, just switch to FaceTime. Oh, there you are. And just walk with it. It'll be really cool. Hey, let me do a quick market test here. How many of you are frequent users of Amtrak and you get to use a lounge at Moynihan Hall? Anybody? Okay, yeah, it's a nice place. Well, if you go in there sometimes and you look for a guy, he's not dressed that spectacularly. He's got a big hat, like a cowboy, not a cowboy hat, a baseball hat on. It might be
a Ducks hat.
What's that?
An Oregon Ducks hat.
An Oregon Ducks hat. It might be Ron Wyden. And I was like walking around this guy, sitting in a chair, and I go, Senator? And we had a spectacular discussion about the IRA. Semafor wrote about some of the senator's ideas about carbon, about climate, that got infused into the IRA. And so, Senator, I want to go back to that conversation and continue it and have our audience understand that you didn't let the wreckage of carbon tax issues just die, and you brought it back. So I want to, we've got 10 minutes and 45 seconds, so I want you to kind of share with us in short form how you think about tax policy and climate as we think about the American economy.
Steve, thanks so much. And it's so good to be with you. And if we've got 10 minutes and I can take 2 minutes, I'll give you a little bit of the long-term thinking that you have to bring to taxes with a situation that's relevant right now. The chairman of the House Ways and Means Committee, Republican Jason Smith, and I have teamed up on what could be a historic bipartisan tax bill, a tax reform bill, and it got 357 votes in the House of Representatives recently. It includes an expansion of the child tax credit, particularly for large, low-income families, help for our small businesses on research and development, and a significant expansion of low-income housing. Now, normally, you can't get 357 votes somewhere to order a piece of apple pie in this kind of climate. And what we're challenged with, and what I wanted to give you an example of, is getting it through the United States Senate now. And some Senate Republicans, for example, are saying, well, let's wait until 2025. And obviously, their own view is they think they're going to win the election. That would give them, leverage. And I've said, look, we've got small businesses that can't wait. You've got small businesses that need the research and development tax credit. If they don't get it, they're not going to be around in 2025. So I want to do smart tax policy now that fits with the future of tax policy when we write the big bill that'll involve $3 trillion in 2025. And the reality is this bill now is paid for by eliminating fraud in a employee retention tax bill, which made sense a few years ago, but doesn't make sense now. So the decisions that you make in tax policy should help people now. They ought to be cost effective. We pay for this bill by eliminating fraud, but they've got to be teed up for the future. And that's what we're doing as we think about.
How many votes, Senator, do you have behind you?
Well, right now, I believe that if we had a vote on the floor of the United States Senate for what's come to be called the Smith-Wyden tax bill, we would get well over 60. The question is, can we get it up on the floor of the United States Senate? Because you need 60 votes procedurally to advance it. We've got a big bipartisan group in the Senate working as well. We've got to take on some of the leadership folks. I get the message that they want to figure out a way to wait. It's just not in the public interest because a lot of these small businesses and families just can't afford to wait. And they make the point, hey, if you're powerful and you have lobbyists, you don't wait. And I want to get this done for kids, small businesses, and housing.
Let me ask you a question, Ron, about the IRA. And we had this discussion at a breakfast this morning where I'm of the view that the part of the bill around renewables and a lot of the part that you were responsible for infusing in could become mincemeat if Donald Trump were to become president. Do you think it is resilient enough? I mean, there was a debate and we had diverse group of people at breakfast that said, Steve, it's more resilient than you think. It's going to be harder to rip up around the climate positive dimensions of investment. Would love to get your thoughts on climate and tax, but the IRA and whether those elements of it are so politicized that they're vulnerable if President Trump comes back.
Steve, every month it gets more and more resilient. And that is because Republican members, not just in the Senate, but in the House, go home and there are all kinds of dedications, for example, solar facilities, geothermal, you name it. And what happens is the local member of Congress is very pleased to be there for the dedication and cut the ribbon. And sometimes people ask them how they voted, and they always say, well, I'm working for this and that and something else. And I think those votes against what we did in the IRA are going to be harder and harder to argue or somehow beneficial in terms of fighting climate change. And you see that with all the Republican members going to dedications that came about because we used these funds. What I will tell you is that after cap and trade went down in 2010, and you all wrote about this, read what Steve's folks are saying, I said, look, we're not going to be able to do carbon taxes. We're not going to be able to do cap and trade. I'm a young member of the Finance Committee, and I'm sitting on the mother lode, and that is the tax code, where you have all this stuff that's outdated, apropos of what I just said, getting ready for 2025. It no longer is a good fit. And Senator Joe Manchin invited me to West Virginia around 2012 or so. I prepared for the meeting, and I said, Senator, how about if we talk about a new start that we can look at for a long term? Let's be technology neutral. We'll say that we're going to have a market-oriented system, and we'll say the more you reduce carbon, the bigger your tax savings. And Senator Manchin, to his credit, said, look, I'm interested in carbon capture and coal and all the rest. Can my constituents be part of this? I said, absolutely. It'll be science-driven. You reduce carbon emissions, you get the benefits of the tax code. That's what became law. And I think, Steve, apropos of the fact that you're planning tax policy for the future, the more you can use the kind of voluntary carrots that Senator Manchin and I worked out there in 2012, rather than punitive sticks pounding on people, the more likely you are to have a winner.
I'm going to go off script here for a minute and ask you something that's come up a lot here, and that is American propensity right now to sanction other nations, sanction other governments, and there may be reasons for them, but we had Larry Summers here and others, and the concern is we may be sanctioning too much. And I'm wondering, and particularly during a period of high inflation, was it a mistake for the Biden administration to not at least temporarily bring down some of the sanctions to deal with supply chain crisis, deal with inflation in a bit? I'm just interested in where you are on sanctions land.
I'm an alliance, guy. I mean, I think the more that you can have friends, I mean, you look at some of the challenges with respect to trade. Yesterday, we had a hearing in the Finance Committee. I called for the administration to initiate more processes to use what's called the 301 investigation to deal with some of these massive China subsidies. I think we could have a tremendous alliance supporting us in those kinds of efforts. So I think you operate under the assumption it's a complicated, world. We had a fair, coalition dealing with Russia early on. It's hard to keep those alliances going, but I think that's a better approach.
You know, we've hung out with you and your wife before. We talked about libraries, books, and you're a big reader of Orwell, and you've been referencing Orwell a lot in the debate over FISA, warrantless wiretaps, data security. We still have a couple of minutes here, but I want to know what your real concerns are about American data security and whether or not, as you've intimated, you think the federal government, including the Biden federal government, is becoming too powerful in terms of its use and abuse of our data.
Well, we're about to consider in the United States Senate a real example of Big Brother. This is really out of Orwell. What happened in the House of Representatives, something was slipped in that had never been discussed in the United States Senate. Nobody had ever saw a Warner Rubio report or some such thing. And it basically would allow the government to force businesses and individuals to spy for them. It changed the language, for example, about who was required. I mean, it was always the phone companies and the internet service providers. It was changed to basically allow scores and scores of businesses and individuals who might have a communications tool, Wi-Fi, routers, these kinds of things to, in effect, be conscripted into being spies for the government. I am going to try to knock this out on the floor of the United States Senate. And I'm just going to say, look, we can have a debate about who ought to be involved in surveillance. I happen to think that unchecked surveillance is pretty much tyranny. And as a first-generation kid whose parents fled the Nazis, in the 30s, and my dad was one of the famous Richie boys who worked for our army and dropped the propaganda pamphlets on the Nazis. We know a lot about surveillance in the Wyden household, and I think there got to be some guardrails and there got to be some checks. And I personally think that security and liberty are not mutually exclusive. Smart policies give you both. Not so smart policies give you less of both.
Senator, where are you on TikTok?
Well, we're not even sure what we're going to be voting on at this point, Steve. But what I'll tell you is,
but just generally, I mean.
Well, I'm going to give you my general thought.
Do you get up in the morning and do you cruise through the videos?
No, but I obviously follow a lot of sites online, but I am not a TikTok follower. What I will tell you, I think there's substantial national security issues because of their relationship with China. I think there are First Amendment issues, there are privacy questions. What I will tell you is I like some of these ideas about divestiture to American firms and the like. I am not in favor of Steve Mnuchin being part of it because of what he has been able to get classified and because of his connections with states, particularly Arab states that are hostile.
Can I trade you a Semafor baseball cap for an Oregon Ducks baseball cap?
I would be honored to show up at a Semafor softball game or picnic or anything and don one of your hats.
Great. Senator Ron Wyden, Chairman of the Senate Finance Committee. Thank you so much, Ron.
Thanks, guys.
Thank you all.
Please welcome former U.S. Secretary of the Treasury Hank Paulson. Returning to the stage is Semafor co-founder and CEO Justin D. Smith.
You want to see here? Hank? What else is here? Good morning. This is a big moment for the World Economy Summit, as you can imagine, to have this gentleman to my left. Really, I think a huge figure in modern American history, and also just one of the most accomplished and most experienced, wisest, level-headed leaders in this country, which is something we need these days. So thank you for joining us, Hank.
Justin, thank you, and I'm delighted to be here. And I like that introduction. I don't get it very often.
I doubt that. I think that's probably on the less flattering side.
Yeah.
We've heard from John Williams this morning. We're going to hear from Kevin Warsh in a minute. This is a global economic summit, but the global economy, obviously, when Washington starts in the U.S., would love for you to share with us your current view of the U.S. economy.
Well, to me, it's a good news story, right? The U.S. economy is outpacing the world. And we've been growing and creating jobs at a robust level. Inflation's come way down, and people would like it to come down faster, but it's come down. Real wages are going up. You know, the word unprecedented and extraordinary gets overworked a lot, but there are a number of unprecedented, extraordinary factors, distortions, and so on that are impacting the economy that I'm not going to get into making short-term predictions in terms of when the Fed might cut, how much the Fed might cut, whether we're going to have a soft landing or a not so soft landing. But I will tell you, the odds of a soft landing are a lot greater than they looked 6 months ago. So I'm going to focus on the one thing we know about the U.S. economy with certainty, and you heard a bit of that from David Rubenstein this morning. Our national fiscal trajectory is unsustainable, right? And the longer that it goes unchecked, the debt we have will ultimately, if unchecked, will destroy our economic well-being and our national security, which is rooted in the economy, right? And the bad news is people have talked about the deficit risk for so long. I think both parties believe that it's crying wolf, right? But the longer we wait, the more expensive it'll be, the more dangerous it'll be to try to dig ourselves out of this morass before it strangles us. So that's the bad news. The good news is...
And anything to do about it?
Yeah, we're a rich country, right? We're a rich country. So if we begin to work on it now, we can...
Solvable problems?
We can solve it. We can mitigate the problem, right? We can mitigate the problem, but it's going to take both tax increases and spending cuts. And in terms of raising the revenue, we can raise a lot of revenue by just doing away with preferences, closing loopholes in the tax code, right? And do it without creating a big drag on growth, because those loopholes are really just spending decisions. That's all they are, spending decisions. And also, it's unpopular to say this, but you can't solve the problem without restructuring entitlements, Social Security and health care. But again, that can be done, we don't have to scare people, that can be done without burdening low-income Americans. There's means testing, there's many mechanisms to do that. So that's how I see the U.S. economy.
So you said it's a good news story, but the one single issue is the federal deficit.
Yeah, I didn't say the one, but that's the issue. That's the overriding issue.
And it's solvable.
Yep.
So, given this strong economy now, and obviously with this looming debt crisis in some time in the future, unless it's resolved, is the U.S. well positioned to compete across the coming years?
We are really well positioned competitively. There's no doubt about it. We have the strongest, most diverse, most competitive, biggest economy in the world. Now, we've far outpaced Europe over the last 10 years. China may someday be bigger, that remains to be seen. But they could never dream of having a GDP per capita like the United States does. And the thing that I don't think we understand well enough is how strong our businesses are. They are the most competitive and strongest, best managed companies in the world. I don't mean to sound nationalistic, but they really are, particularly in the most important industries. You take technology. We dominate technology. Our companies lead everywhere in the world. So that's a huge strength. And then in terms of energy, we're going to increasingly see competition for energy, right? And energy security, the cost of our energy, we live in a safe neighborhood. We're not surrounded by enemies. So again, I think competitively, we've got just the two issues we got to deal with are debt, which is a ticking time bomb if not addressed, and dysfunction right here in D.C. But the world's crying for leadership, and we're best positioned to provide it.
So all green lights except for debt and dysfunction.
Yep, big except fors, but let's emphasize the positives, right?
Well, I said many, many green lights. And the debt is solvable. What about the dysfunction?
What about the what?
The dysfunction.
The dysfunction, I'm going to let someone else deal with that, right?
Okay. So when you look beyond the U.S. And you look at the global outlook, it's obviously a changing, evolving picture. What does your global Hank Paulson dashboard look like of the global economy, of the trends that you're most focused on?
It's a dashboard that is flashing yellow. My wife heard me the other day and said I sounded like a grumpy old man, so I don't want to sound too grumpy, but the level of complexity, adverse trends and risks, I think threaten to make the world a less prosperous and a more dangerous place. And I just tick these off very, very quickly. And of course, you see technology and AI advancing very quickly. And that could be a big positive, right? Because it has a prospect of huge benefits for humanity. But also, I think we're being naive if we don't think it's going to be disruptive in certain industries and there's going to be job losses. And I think we're also being naive if we don't recognize technology is growing in many ways faster than policymakers' ability to understand it and manage it. And then, as I look at the world, I see growing nationalism, isolationism, growing protectionism, which is going to be very big, regional trading sectors. So I see that intense competition for capital, for energy. Energy security is going to be a big focus, and intense competition for energy and lower cost energy. And then I think people talk about climate change, but do they realize we're just going to see, increasing frequency of high intensity climate-driven weather events, okay? Climate shocks and disasters which are going to hit the most vulnerable populations the hardest, and an alarming destruction in nature, in biodiversity. And then when you look at the macroeconomic landscape, I guess the way I would put it would be that there's big imbalances in terms of macroeconomics. Governments have very high levels of debt, so that's a huge problem. Big macroeconomic imbalances, stresses, and strains, which mean that there's a probability that over the next several years, we're going to see financial, economic shocks, disturbances, crises. And then of course, the elephant in the room, which is conflicts. We're looking at, just look what's playing out in the Middle East right now. So the war in the Middle East, the war in Ukraine, conflict in the South China Sea. So there's always a risk that would spin out of control. And so as I look at it, I would see now more than ever, the world needs U.S. leadership. It's crying for U.S. leadership. It's indispensable. I think it's going to be harder to provide unless we deal with the dysfunction in D.C.
So now to maybe the other elephant in the room. We're also talking with someone who maybe is the most experienced thinker and actor on the global stage in terms of managing the U.S.-China relationship. We're obviously in this very fraught, fearful time with all sorts of voices emerging, some quite shrill. about arguing for everything from aggressive decoupling to all the way to the far extremes of Cold War rhetoric focused on the U.S.'s need to have total victory over China and even demand regime change. This is an existential threat. This is actually in the debate right now in Washington, and it's not the extreme. It's being written about in important magazines and so on. What do you make of this debate?
Well, let me tell you, we've got a limited amount of time, and it's a big question to unpack. But I'm going to focus on the debate you said was extreme debate, because I think you're increasingly going to hear that the strategy for dealing with China from the U.S.'s standpoint is not just going to be aggressive economic disengagement, but it's going to be full-scale confrontation until they give up, stop challenging the United States, have their regime change, right? The model that's being put forth is the model, the Ronald Reagan Soviet Cold War model, which is total victory. That's the goal, and I think the Cold War, Soviet Cold War analogy is a very bad analogy. You heard from an impressive speaker from South Africa, and to begin with, there's an increasingly important, prosperous, growing in prosperity part of the world in terms of the global South, Africa, the Middle East, that look quite favorably on China and are really quite dependent on China for major investments, economic linkages, and increasingly dependent on China for technology. And then, the other thing that we can't ignore is China is the leading trader with countries that are responsible for 70% of the world GDP. So China is an economic powerhouse to the extent that the Soviet Union never even dreamed of becoming.
So what should we do?
Well,
if that's a flawed analogy, what should we do?
Okay, so first of all, I think there's a number of tests every U.S.-China policy has to meet. First one, is it realistically obtainable? Do we have the means to achieve our objective? And secondly, right, if we're going to need the help and support of our allies, and partners, are they going to follow us, right? And then we have to ask ourselves, are there certain high priorities we have as the United States of America where we're going to need some cooperation or some way of working with the Chinese, and does our strategy let us meet that? And then lastly, if we lay out goals that are unrealistic and unobtainable, and we don't meet those goals, what's the cost to the United States in terms of lost prestige or being isolated from the rest of the world, right?
So we'll stop right there. So 4 tests.
Right.
So how does this strategy of total confrontation, Cold War, Reagan, tear down that wall, does that strategy meet those 4 tests?
Victory through confrontation. Yeah, I think it get by the first couple of tests, right? So I think it's a huge stretch to think that we're going to get other countries to follow us. Many of our partners and allies, they want a strong security relationship with the United States, but they want an economic relationship with China. So even under the current approach and policies, we're having a very hard time getting our allies to do more than just sequester sort of the most sensitive, the most advanced technologies that are vitally important to economic security. And even there, it's a real struggle. So most countries are actually looking to expand their economic relationship with China. I don't say this critically, but Schultz was just there from Germany, and he brought a business delegation with him. I mean, so we need, so many of our allies are focused on growing their own economy. You know, I don't believe, if you look at Asia, if you're looking at, you know, South Korea or Japan or Indonesia or India, I don't think it's in their interest to have U.S. primacy, you know, in Asia. So again, I think what we need to do is be relentlessly focused on our priorities, do what makes sense for us.
So, all right, well, let's do a kind of a time warp question. What would Ronald Reagan do today if he were in office?
Well,
would he do what this argument is saying? Would he say tear down that wall?
I tell you, that's unknowable. Of course, every Republican wants to channel him, right? And Nixon not so much, and many Dixon.
That's why I asked it.
So I'm going to tell you. So what I am 100% for a strong U.S. You know, emphasizing our national security, having a superior defense capability, sequestering the most sensitive and advanced technologies, right? But let me tell you, as I remember Ronald Reagan, he negotiated with the Soviet Union. He negotiated with China, right? So he was a pragmatic person.
But to what extent do our interests require some coordination with China?
Well, you know, that is, I look at interests that I look at as close to being existential, right? You know, for instance, the battle against climate change, nuclear proliferation, cyber warfare, and so on. And I think it's hard to see us making much improvement to mitigate these things without working with China in some way, some degree of working in a complementary way. I just see that. And it's hard to figure out how we leave room to do that if we have a, you know, confrontation, total victory kind of strategy. So
just quickly, two last questions. One is your view of the Chinese economy right now. We can just do a quick lightning answer.
Okay, so this will be a quick lightning on China. Okay, everybody's focused on the structural challenges China has. Precarious real estate market, you know, too much debt at the subnational level, over-reliance on, you know, on exports and infrastructure investment to drive growth, income disparity, high levels of youth employment, the demographic issues they've got with the aging. And right now, they're dealing with, you know, consumption is way down, and they're fighting deflation. So that's structurally. And structurally, I think most people believe, and I believe, that the days of double-digit growth are gone. I think the thing that I'm watching most carefully is the fact that China has moved in a very big way to put the party into all aspects of the economy, right? And emphasizing security over growth. And you know what that has done? It's sapped the entrepreneurial spirit of the Chinese people that has been key in driving growth. And then what you've seen is a lack of transparency, very hard to get good economic data. You know, vague, you know, arbitrary enforcements of vague laws like the National Economic Act, Protection Act. And so all of this is really stifled people's, it's made it much more difficult to do business in China. And this is not just for foreigners, but it's for domestic market participants. So what I'm going to watch most carefully here is not just the structural issues, but how this statist approach to the economy plays out. Because if China stumbles, it's going to reverberate around the world, and you know it's going to have a strong impact.
So a thread through all your comments on the U.S. economy, the global economy, China, is that there's so much good news. The U.S. is so well positioned, yet we're facing the most dangerous and frightening dashboard of risk. leadership, and leadership is needed, and the U.S. is best positioned to do so. In 2008, for 3 weeks, someone wrote, or a journalist wrote, that one person was charged with preventing the collapse of the global economy, and it was Secretary Paulson facing the financial crisis. So this is a case of leadership in crisis that you experienced. What lessons from that time can you offer to the leaders in America now, around the world, as to how to deal with all these crises that we're facing?
Well, it really comes down to trust, right? And so the blessing that I had was I had a year before the crisis struck to build the relationship of trust with President Bush, right? Because I negotiated all kinds of things, but if I didn't have a relationship of trust with him, he was the president, and it wouldn't work. And I had a chance to work with Congress and get things done with Nancy Pelosi and with Harry Reid and with Republicans, and get stimulus done and trade acts and build trust. So I think that was important. The other thing, a crisis, it's whether it's a big global crisis or a small crisis is pretty much the same. I mean, if you're boiling in oil, it doesn't make much difference if it's 180, 190, 200, right? We've all been through the crises, and so to me, the key thing about crisis decision making is if you wait till you get all the information you'd like, you're looking in a rearview mirror and it's too late, right? And so when you're dealing with a big, messy problem, there's never a neat, elegant solution. So you're being forced to decide between doing something that's messy and not perfect, or doing nothing, which would be worse. So I think the thing about crisis decision making is being prepared to act, but then if you make a mistake, correct it. Because I made plenty of mistakes, but the thing I'm most grateful for was the big mistakes we corrected right there on the battlefield, right? With Fannie or Freddie, I told Congress, if you give me unlimited, I couldn't get unlimited authority, so I had to ask for unspecified authority, right? And so I basically said, if I get it, I won't have to take the bazooka out. Well, guess what? I had to take the bazooka out. I didn't think I would, and I took it out. And the same with putting capital in the banks. I didn't know how to do it without nationalizing the banks. But by the time we were up at Congress, we had a couple big banks go down in the United States. It was accelerating around the world. And I went to George Bush and said, guess what, sir, we're going to have to put capital in the banks. And he said, you told the whole world you weren't. I said, I'm just going to say we made a mistake. We're going to put capital in the banks, right? And we recapitalized a couple hundred banks quickly. So to me, that's the biggest thing, and it's no different whether it's a national crisis or whatever. To me, you just need to be prepared when you make a mistake to move quickly to correct it.
Great. Well, with that, please join me in thanking Hank, Secretary Paulson, for a great conversation. That was great.
Okay.
Please welcome Adam Posen, president of the Peterson Institute, Kevin Warsh, former member of the Federal Reserve Board of Governors, and Karen Carniol-Tambor, co-CIO of Bridgewater. This conversation will be moderated by author John Hilsenrath.
Thank you, everyone, for joining us. So the title of this panel, I think, is Making the Grade, Assessing Central Banks. I want to start off with Kevin, right to my left. Grade the Fed. How have they done in the last year? And what would you do differently if you were running the place?
Well, thanks for starting us off with a softball like that, John. So John used to cover us back in my days at the Fed a long time ago. In terms of letter grades, sort of in modern elite institutions, certainly of academic learning, we don't give letter grades anymore because we don't want to offend the sensibilities of our students. We want them to feel like they're all getting A's.
Pass, fail? Or are you going to give them a pass?
So I guess I'd say needs substantial improvement.
Okay.
I think that's as far as I'd go on a grade. It's a beautiful day in Washington. I don't want to start out too critical. In terms of what to do differently, I think in light of the biggest economic policy error in the last 45 years by the central bank, which led to this massive surge of inflation, in light of the errors that have made in the last 6 months, promising in December that mission accomplished, we'd hit our inflation objective, now having to lurch back to the other side in recent days, I think my best advice is deep introspection. What are the structural errors we're making in thinking and conducting policy? What is our theory of inflation? In some sense, the Fed's theory of inflation reminds me of the dominant theories of inflation in the 1970s. And it goes something like this. America's inflation problem is because workers are earning too much and living too well. Well, I don't believe any of that. America's inflation problem is because the government's living too well, spending too much, printing too much, monetizing too much. And I think at the core errors in the conduct of policy is inability to think anew about what is inflation, how do we measure it, and lastly, who's responsible for it. And I'll just end with a final word, John, which is inflation's a choice. It's a choice largely by the fiscal and monetary authorities. Inflation isn't subject to war and pestilence. The Fed isn't a victim. This isn't anguish. The Fed is responsible for the inflation rate, and the Fed needs to take ownership of it.
So I want to come back to some of this, but first I want to move on to Adam. Inflation is the question of the day. The Fed, as you said, suggested that it had they felt they had the job done by the end of last year. We've gotten 3 months of not so great data. Adam, what is your outlook for inflation in 2024? Is it coming down, and is the Fed going to cut rates this year, or are they going to end up in a position where they either have to stay on hold or raise them?
Well, thank you, John. Thanks to Semafor for having me. I want to generally associate myself with the thrust of Kevin, that the Fed has been communicating in a very data-dependent and therefore extremely inconsistent way, and it comes out of some mistakes and lack of knowledge or lack of rethinking. And that doesn't mean that the rethinking is easy or obvious. But so when we get to the inflation outlook, I'll try to be disciplined and respond to your questions, John. When we get to the inflation outlook, I think I've been saying for a while now that the Fed was going to cut fewer times later than what markets priced in. I think the upside risks of a hike in 2015 are much higher. Not so much because inflation is going to go way up now, but I think the odds, either way, whoever wins the election, of some additional fiscal excess and uncertainty and the ongoing legacy of the industrial policy, which are these open-ended commitments that could add up to hundreds of billions of dollars, mean we're going to have inflation in 2015. And so I think it's less about this year. They probably will hold off, and that's probably right. 2015, you mean 2025? I'm terribly sorry. I'm old.
Yeah.
2025 to all you young people.
Yeah.
Thank you for correcting me.
So are we going to get to 2% this year, or are we stuck in this?
I think headline will fluctuate around 2% and a little higher. I think there is all this, if you want to get into the arcana, as I know our colleagues do, about rent and how rent gets translated and energy prices coming out of the Middle East and so on. I mean, this is the one place I slightly disagree with Kevin, is that sometimes you do get inflation for reasons that have nothing to do with the Fed. The question is, how fast do you bring it back down? And so we could get inflation because of the Middle East, because of energy, because of something else. But basically, inflation's going to be running, I think, core inflation is going to be running basically flat where it is now.
So, Karen, I want to talk about fiscal policy. There's been a lot of talk today, including on this panel now, about large budget deficits, large levels of federal debt. In the 1990s, we had these creatures on Wall Street called bond market vigilantes that sent a signal to Washington: you have to get deficits under control. It led to elevated long-term interest rates. The bond market vigilantes appear to be dead. Where are they? How do you think about budget deficits and debt and the sustainability and how you price a bond as a result of that?
So the first thing I'd give perspective on is it's been a very, very, very long time in any market trader's memory since supply and demand really set the price of bonds, meaning that the people who had to buy all the issuance done to fund the fiscal deficit were people who cared about price, looked at the bond yield level and asked themselves, is this a good bond yield? And I would go back before quantitative easing. I would go back before the financial crisis to when what you had going on was, the rise in emerging markets and the desire to keep their currencies low and the need to basically accumulate dollars in order to keep their currencies low. That was a tremendous flow that went into the United States bond market regardless of what the yield was. And so you sat here in the early 2000s and basically said, wait a minute, a lot of people are willing to buy US debt not caring what the yield is because of other reasons. These are not people who are driven by profit and loss. And we know what the effect of that was, right? Which is that yields were lower than they need to be, interest rates were lower than they need to be. That forced someone to borrow. So not only did the government borrow as much as they wanted, but other people did, mostly households, and then we got a housing crisis. Then you go into the financial crisis, and you get the era of quantitative easing. That is a massive, massive, massive buyer that doesn't care about price, right? The Fed is not in there saying, I'm going to decide what the right bond yield is. And so now it's going to be the first time in 2025 or so where you'll actually need whatever the government's going to borrow, you'll need to actually find private capital willing to say, I like that interest rate, and I choose it over other things.
So are you saying that the bond market vigilante is going to make a comeback? And that we're entering a period where there's a premium again, a term premium again for owning long-term debt?
Well, first I'd say bond vigilantes did come back in the UK, right? Like they went through a very clear bond vigilante episode, which said, hey, that's ridiculous. You can't do that fiscally. That's not going to work. Now, of course, exacerbated by different liquidity dynamics and whatnot, but I would say that was a bond vigilante episode they just went through. Whether the US goes through it really depends on basically what the exceptional status will remain for both short-term US debt, which people consider literally equivalent to cash. So the one thing that the US Treasury did, which no other Treasury has done to anything like this degree, is say, wait a minute, I need to issue a lot. You know what I should do? I'm just going to do it all in T-bills. I mean, can you imagine if like the Brazilians were like, you know what, we're just going to fund it all on 3-month paper? That would clearly not work. But for the US, it could. That's a very unique economy that people think of T-bills as literally the same as cash. And then on the other side, what will happen abroad will happen to other buyers that might be uneconomic, how much they're going to want treasuries. But the probability, I would say, that bond vigilantes will be relevant again in the next 2 years is pretty meaningful because we're just going to have a lot less uneconomic buyers and a fiscal level that's a lot higher deficit than we had before for kind of structural reasons, leading to you really do need to compete for that capital. And the private market can send a signal that there's too much borrowing being done by the government for the first time in a long time.
Can I just piggyback one point? I think she's absolutely right. And the UK is a warning to many people, if not the US. But additionally, because of the tensions with China from the US, from others, we're starting to see barriers go up on flow of investment back and forth between China and US. And so going back to the early 2000s, I think I got the date right, if we're reducing the ability of savings glut from East Asia and China in particular to come to the US and buy treasuries or making it less attractive, that's another force up on bonds in the same spirit, that you're having a smaller pool of private borrowers who are price sensitive.
Kevin, what do you think? You think that if you were a policymaker in Washington right now, would you be concerned that there's a bond market blowout coming down the road?
So I'm a risk-averse, has-been central banker. Everything worries me. I associate myself with my two colleagues up here. The U.S. government is about 40% bigger than the day before COVID. According to the president's budget, the size of the government, the expenditures of the government will be larger than it's ever been in the history of the world for the next 10 years. And my recollection of history is we can set tax rates wherever we want. The American people will only give us something like 19% of GDP. And if our government's spending on a federal basis 25%, that is begging the bond vigilantes to wake up from their slumber. I think good policymakers shouldn't be asking for the fight. They should be establishing some sort of fiscal anchor, some description that we are going to, especially at a time where the economy is at full employment, act within our means. Instead, what are we doing? We're begging the world for money at a time we shouldn't need it for a size of government we've never had, many of which for expenditures are not at all obvious that we need. So I think it's a problem. And I think Karen's point is the right one worth emphasizing. For most of the last 15 years, really since the 2008 financial crisis at least, the four largest buyers of US government securities were price insensitive: the Federal Reserve, the Chinese, the Japanese, and the big banks. Well, on the margin, they're all exiting that market. The Fed wants to get back into a balance sheet that's growing again, but inflation's making it harder. Buyers 5 through 50 will demand a different price. I think if you look lastly at the example from last fall, 10-year Treasury yields, this is the most important asset, the most important price anywhere in the world, and 10-year Treasuries went from about 3.8% to a bit more than 5%. And our government said, that's too expensive. And so what the Treasury did, and I understand why they did it, is they said on the margin, we're going to issue more T-bills. This is Karen's point. 10-year Treasury yields went from 5 to 4 very quickly. Well, they're creeping back up. I think that's the market's way of saying that the market clearing price, if you don't have these artificial buyers, is closer to 5. And that is huge fiscal implications. I'll just end with one statistic. For every percentage point that interest rates are ahead of the Congressional Budget Office estimate of what our government's funding costs should be, their average is around 4. For every 1 percentage point increase above that, then the increase in government interest expense the next 10 years is $2.5 trillion. This crowds out things like that we need: a stronger military, a strong safety net. And this is creating a new $34 trillion entitlement that someone needs to defease. Imagine that we're not at a time of full employment. Imagine a time things are worse. Imagine a time that these wars just aren't some faraway place. We need to have the fiscal capability and credibility to tackle it.
So, Kevin, I have to ask you, your name is sometimes floated as a potential Fed chair in a Republican administration. Do you have a desire to get back into the game of policymaking?
So you'd think with John, having covered me for years, he would avoid these sorts of questions. The Chairman Powell's term ends in May of 2026, as far as I can tell. That's a year and a half into the new administration.
Let me cut off your non-answer.
Yeah.
And
Hold
ask
on.
you.
I'm preparing another non-answer, but go for it.
Okay, all right. The question is, do you have putting aside with Chair Powell's term, do you have an interest in being back in a policy game, or do you like it in the cushy environment of not giving students grades that might hurt their feelings?
So if you believe what, I'll put words in Adam's mouth, and he should feel free to disabuse them of. If you care as much about the country as we do, and you feel as though you've been so blessed to have incredible opportunities in the country, if your government calls, you have an open-mindedness to serve. If you believe what I believe, and a lot of people in Washington don't, so correct me on this, this is a hinge point in history. You might not know it when it feels like we're at full employment. This is as consequential a moment for the United States and the world as we've had in my adult lifetime. In some sense, more consequential than the darkest days of the 2008 crisis when I was serving, where we in some sense didn't know exactly what to do, but we knew directionally what to do, and the whole world was there to help us and support us. People that we consider adversaries of the U.S. flew to Washington in the dark days of the 2008 crisis and said, what can we do to help? If the world ends up in a darker place economically, geopolitically, do our allies trust us and come to our aid immediately? Are adversaries fearful of us and respect our fiscal and monetary capability, never mind our credibility on war? I don't know. So I think it's a hugely consequential moment. If we get the next few years right, 21st century can be America's and the world can be better. If we get it wrong, I think it's pretty dark. So that's not a non-answer. The country needs, I think, new thinking across fiscal and monetary policy.
As a student of Kevin Warsh and central bank speak, I'm going to take that as an emphatic yes. So, I mean, there's a lot of conversation here about the mistakes that the Fed has made letting inflation get out of control, the problem of U.S. debt, rising U.S. debt levels, and yet, when you look at the value of the dollar, and going back to the days when I was covering the Fed with you, I heard people say over and over again that the Fed is going to destroy the value of the dollar. It's up 11% over the last 3 years. So, Karen, I want to ask you, how do you explain that, and how do you trade it?
So, not to be over dramatic, but I think the U.S. has a version of what economists thought of as Dutch disease with financial assets. Meaning classic Dutch disease is like, I go fill my car up with gas. I'm not thinking I want to give money to Saudi Arabia. I'm just, whatever gas is there, I get. Right now, if you look at all the cross-border savings around the world, so every dollar in the world where somebody is saving in a country other than their own, 80% of that is ending up in the United States. And it's not because everybody just loves the US so much. You just look at the indices and you say, well, if you want to invest in stocks, what stocks exist in the world? It's mostly US stocks. If you want to invest in bonds, well, guess what? Japanese bonds are all owned by the Bank of Japan. You just don't have that many options of financial assets to invest in. And what the dollar move is telling you is that there's still more desire to buy all these financial US assets than there is on the US side to be, spending and buying foreign exports and so on. And some of that comes from really believing in the US. The reality is the US has outperformed in really every possible way financially. So there's a reason why its assets, especially the stocks, have grown in market cap. But some of it is just normal. You invest according to what assets exist. And what that means is that the dollar is being supported by this kind of flow that thinks about, just wanting to invest cross-border and ends up in America. That used to be very bond-oriented because it was very much these central banks looking to build up reserves. Today, a lot of that money is stocks. And so it's shifted much more to private sector players that are actually trying to make money off their investments. But the vast majority of what will drive whether their investments make money or not is the success of the stocks, not what the dollar does. The dollar is kind of an addendum in terms of how it performs. And so that's a lot of money that's showing up here and supporting the dollar and supporting it regardless. And I think it's interesting if you think about a world where Trump comes back in, you end up having more extreme tariffs. In some ways, that just becomes more dollar bullish because you make the trade deficit smaller, but you don't reduce any of these people's desire to be buying all these financial assets.
Right, so we have zeros across the clock. I want to ask everyone to give me a one-sentence answer. What's the biggest risk on your mind looking out over the next year for the global economy, the markets, or whatever it is that's bothering you? Start with Kevin. One sentence.
War.
With war between who?
Old-fashioned war.
Okay, all right. We'll leave it at that. Adam.
Further decoupling China and the U.S. feeding into war.
Karen.
Oof, it's hard to top those two. Let me add a milder form of this, but different accelerating Chinese economic warfare with the Chinese if we don't get hot war.
Okay, on that happy note, thank you.
Please welcome Representative Patrick McHenry of North Carolina, Chair of the U.S. House Financial Services Committee, and returning to the stage, Semafor Business and Finance Editor Liz Hoffman.
Thank you. Thanks for having me, Liz.
Thanks for taking the time.
Absolutely.
This is a global audience. I think a lot of whom sort of look at the Republican caucus inability to move on Ukraine. Every time the debt ceiling comes up, it becomes some sort of catastrophic hand-wringing, budget negotiation. How do you kind of convince the world that America has legislative credibility to lead on a bunch of really important issues?
So it looks a bit shambolic. That is a very British term, but it applies here. It's been messy. It's been a hell of a messy Congress, that's for sure. But the credibility of the American government is that we get things right eventually. And we're getting to the right place eventually. Ukraine funding, support for Israel, this should have been done months ago. We should have been done with this in December, but we're getting to it, and we will have a successful result, I believe, at the end of this week. Whenever we're done for this week. No, tomorrow's Friday, but we will eventually get this done before we leave town. And that is a very good sign that America is still a force for good in the world, and we support our friends and allies.
Okay.
I said eventually. I didn't say on this day or this moment. We get it right over time.
But it's a messy caucus. I'm just, how do you think the Speaker has done kind of managing the...
Look, we gave him a very tough job.
You had the job for a couple of minutes there.
I did 23 days and as Speaker Pro Tem. But what I said to my Republican colleagues, we're in the majority. It is your decision on who we elect as Speaker. That is traditional to the House for the last 170 years. That's been the case, that the majority party elects the Speaker. And we went through 5 iterations. And Mike Johnson came to the floor without a dissenting Republican vote. Which is a major mark for what was a very dusty, rough time for House Republicans. And it's been a rough time since then. The pace of play is not what I think it should have been in moving policy, but he's inevitably gotten to the right outcome on enacting our spending cuts in a full-year appropriations package, reauthorizing FISA so that we can still protect American citizens and global allies, and with the best intelligence capacity on the globe, as well as coming to the right conclusion on this national security supplemental that will be signed by I believe will be signed by the president in the coming days. And so he's gotten there, but it's been a very, very rough time. We gave him, well, frankly, we threw him in the deep end of the pool with the heaviest weights around his shoulders and said, learn to swim. So it's been a rough go of it, but he's gotten to the right place, and I support the Speaker and want him to fill out his term.
Speaking of terms, you're not running again. You're going to stick around until your term?
Oh, yes. Yeah. Look, I got elected to a 2-year term. I have an obligation to my constituents who elected me, and I've got work to do. I've got work in the House Financial Services Committee. We've got major priorities that because of what's happened in the House of Representatives, that we've got this logjam of bills that are still awaiting floor time and floor action. And I, like many committee chairs, are very frustrated about that. And I, like some of my colleagues, have expressed that frustration. But I've got a legislative agenda I'm still pushing very hard to enact.
Feels like embedded in that, if I can speak for you a little bit, is perhaps a criticism of some of your colleagues who've sort of thrown up their hands and walked out the door?
Look, everybody, they need to make a decision for themselves on leaving before their term is up. But look, it's a 2-year term. This is not a new thing. It's been around for, as long as the House of Representatives has been around. We have a 2-year term. And I think I have an obligation to my constituents who gave me this opportunity. I have an obligation to my colleagues, Republican colleagues, that put me in the position to chair the Financial Services Committee. And I have an obligation to my committee members on a bipartisan basis to move their agenda that we've passed out of committee. And I want to realize the results of that. I made that commitment going into this Congress, and I'm going to go fulfill this. And look, that's an obligation I have, and I feel that obligation. I feel that weight, and it's an important weight when you're in public office to know that people put trust in you to do your best. And that's what I'm trying to do.
All right.
Thank you. Thank you.
Let's talk about that agenda. You've been pretty critical of financial regulators. talk about, I mean, talk about what your problem is, because there's been a lot of problems in the financial system, and they are responding to some of them. So what's your beef?
Well, the holistic review of capital pushed by Michael Barr at the Fed, his justification was were the bank failures in March of last year. His regulatory response has nothing to do, nor would have stopped those 3 bank failures in March. And so he is using that as justification for his political agenda. And so I'm critical of it because there's a lack of economic analysis. There's the lack of building consensus in the Fed, which is traditional to how the Federal Reserve works. And if it lacks economic analysis, it's not conforming with how the Fed moves consensus products, then it looks like a pretty gross political agenda, not something responsive to the economic needs of financial stability. So I've been critical. Yes, absolutely. But I've also, when the administration has gotten it right, like when the president appointed Janet Yellen as Secretary of the Treasury, I commended his nomination in a really terrible time in American politics in the early months of the Biden presidency. I mean, politically terrible. And so I think to have credible, smart people in these important seats matters, rather than folks that are pushing a political agenda, and to be responsive. It also means being, not just competent in the political term, but competent in how you run the agency. And that's why I've been critical of Chairman Grunberg and how he's run the FDIC. And I think that agenda doesn't match what is necessary for proper bank regulation. And so, look, I'm kind of a let's be normal in government, right? Which is, I know, grossly is very out of step with the current politics. But let's have smart, effective people that are in the political mainstream, hold important positions of power. That's how we've designed these agencies. But we have to have competent people that are in the mainstream. And some of the Biden appointments and some of the Biden positions have been positioned well outside of the political mainstream. Like the FTC's approach to competition law is not traditional. It is a complete break with the last over 100 years of how we approach competition law. Let's actually try to be normal. We are the most powerful country in the world with the greatest economy, with the most deepest, most liquid capital markets in the world. We have a banking system that is the envy of the world. Let's be better versions of ourselves. Let's be better versions of ourselves, not sad replicators of others around the globe. That's what I'm trying to drive. That's not a Republican agenda or a Democrat agenda. That's an American agenda driven for the better outcome for the people of our country and the world.
Speaking of having sort of competent technocratic people in the right seats, I realize you will be a private citizen if and when this happens. But if we get a second Trump administration, are you confident in his ability to bring in financial experts who can steer the economy through a pretty tricky landing?
No, that's my hope. And from the first administration, what you saw, the leadership of the FDIC and the SEC, his appointments to the Federal Reserve, are all highly proficient folks that carried out an agenda that was focused on economic growth and right-sizing outdated regulations. And I think that was a reasonable agenda. And I think you saw that with Jay Clayton's leadership of the Securities Exchange Commission. I think you've seen that, notwithstanding the last panel. I think you've seen that with Jay Powell at the Federal Reserve. I think you saw that with Yellen and McWilliams at the FDIC. Those are great examples of folks that have performed well, that are in the normative bounds of a conservative administration. And I think Biden would be in a better position politically had he done the same with his appointments rather than kowtowing to a group of progressives and the politics of the Hill and his party, but being in the mainstream would have been much more helpful and additive to our economic stability.
Another place you've been pretty critical and outspoken is on ESG and its sort of intersection with investing. Correct me if I'm wrong, I don't think those bills have moved, but you've had a pretty wide agenda. Talk about kind of both your goals, but also what's happened live around them. I mean, there's been a swing a couple of times in the 2 years you've been talking about this.
Oh, yes. Look, we moved a major set of corporate governance initiatives out of the committee in July of last year. And my hope was that in the fall, that we would be able to move a significant amount of our committee agenda across the House floor. That didn't happen, mainly because we took 4 weeks to navel gaze as House Republicans after the motion to vacate and trying to get back to our business in government funding and these very, very important initiatives that had to see floor time across the House. But what I set out in January of last year was to focus on the economic issues that mattered in the political debate on ESG, which meant I had to ensure that my colleagues understood that the E, the S, and the G are not about politics, right? If a company is concerned about the environment, that was first an economic metric, not a political metric about climate change, not a political regulatory agenda about climate change, which it's morphed into. So I wanted to separate the politics of ESG to the corporate governance good and separate out the E, the S, and the G, okay? Which is very hard in the politics we're dealing with. So what we produced out of the House Financial Services Committee are important corporate governance changes and reforms. And a significant portion, if stood alone, would have resulted in a significant number of Democrat votes. So corporate governance changes and updates rather than the politics about climate change, which there are a lot of folks that want to have that food fight and battle. I'm not interested in that. I'm interested in what non-economic players do to influence corporate decision-making and the economic effects of those. When you have non-economic players, like proxy advisory firms, that are playing this outsized role on how corporations make decisions, but they don't have economic skin in the game, I don't think that is in service of economic growth, nor do I think it's right for the best and greatest capital markets in the world to do a sad flavor of European regulation.
What about on the other side, though? Because there's non-economic actors on the right, for example, kicking banks out of municipal underwriting in Texas. Turns out that results in higher interest rates for Texas taxpayers. So how do you think about politics on the right, kind of weaponizing ESG as a financial metric?
Yes, well, that was a response to the politics of ESG, and I think a pretty poor response. And so what I'm talking about is how do you make economic decisions related to economic matters and let politics be politics, right? I don't expect the C-suite in every corporation to opine about every stupid bill I have to vote on in the House. I don't even want to opine about most of the votes I have to cast in the House of Representatives. And if you get to the state legislatures, I sure as heck don't want to get into opining about those votes. So we should separate out corporate America having to engage in every bit of politics on every vote of every state in the nation, and let them be economic actors. An important role there, an important role that we have proper corporate governance, that stakeholders have a say, shareholders have a say in those decisions, not politicians just taking shots. And that's what we're in this. We have a left and a right food fight. You have blue states going in the direction, one direction on corporate governance, and red states in going the opposite direction, in a divided America. There is no win for that. In fact, America loses if we allow ourselves to have half the states have left-wing initiatives on corporate governance and half the states have right-wing initiatives to counter that. We all end up losing in that. So I'm trying to avoid that outcome and try to play it down the middle at a time where if you're trying to play it down the middle, you usually get run over.
Well, in 9 months, this is someone else's problem. We covered a lot of ground. Thank you so much for the time.
Thanks,
I appreciate it.
Thank you all.
Thanks.
Please welcome Daniel Pinto, president of JP Morgan Chase, and returning to the stage is Semafor senior editor Gina Chon.
you, Daniel, for being here. I wanted to start off with just given JP Morgan's perch in the global economy and how much the bank is able to see because of its size, and you just had earnings as well, just a sense of the state of the consumer and the health of them, given we've seen, at least here in the US, very strong retail spending numbers, but maybe the health of their credit is starting to ebb a bit. What are you seeing at the bank through your customers?
So we thought, nice to see you. Thank you for inviting me. We have 82 million customers in the United States, so we have a good picture of what is going on, and what you see the consumer in a very, very good place. So the bulk of the mortgages have been refinanced at lower rates, even though there is a lot of people are talking about over leveraging credit cards or borrowing a lot again credit cards. When you in a nominal terms is true, but if you adjust by wage increases, it's lower than it was in 19. So there is still some excess savings, particularly in the more affluent part of the consumer side.
So they still have some cushion, actually.
Yeah, there's still some cushion, a little less in the more mass affluent, more on the more affluent part. So the consumer is in an amazing place. And since the unemployment rate is so low, people have their jobs, they have, and markets, equity markets and credit markets, they are very good. So people feels wealthy. They have their jobs, and they have an amount of debt that is very manageable, and they are not exposed to higher interest rates, so less exposed to higher interest rates for now. So it's not a surprise the consumer is in a good place.
So what do you think that means for the Fed and central banks just around the world in terms of when they can cut? The prospect, we had John Williams here earlier, he said his base case doesn't include any rate hikes, but there are some who are wondering if that could be on the table, just given how hot the economy is.
It's possible, but in my view, very, very low probabilities. I think that monetary policy is quite restricted. Inflation is a bit over 3%, and rates are about 5.5%, so you have a big cushion. So it's not a surprise that monetary policy is finding a challenge to filter into slowing down the economy for what I said from the consumer side. So they are less exposed to interest rates. The same for corporates. They are very well funded. They have long-term. There are a lot of hedging being done, so they have long-term funding. So there are not big imbalances in the U.S. economy that higher interest rates is going to have a massive impact. So the scenario, I remember in in January this year when we were at Davos, the market was pricing 7 cuts. And that, no matter how you cut it, didn't make any sense.
Rational exuberance, I would say.
Because if you believe in that, you would not have the S&P at whatever it was, the all-time high at the time. So the economy was doing fine, and so therefore it was very rational to assume that that amount of cuts will not happen. Now there are 2 priced before the end of the year. I think that there is a relatively, in my view, high probability that the Fed will not cut at all this year. Because inflation, particularly in the service sector, is kind of struggling to find their way down. So I also don't believe that it will be necessary to hike from here. That's why I think that the probabilities are low. But if the Federal Reserve does need to hike from here, so then the sort of benign outcome that we are seeing, soft landing and all that, may be in jeopardy. I think that there is a relatively decent scenario that the economy slows down a bit, the soft landing happens, the cycle gets extended for the next 3-4 years. Even if rates stay high for a bit longer than the market is expecting.
Well, we just had a panel earlier that was grading the performance of the Fed and some finance ministers. How do you think the Fed has done so far in managing this? There's, been questions about the Fed credibility when they weren't able to get inflation down, and the whole transitory debate. We've now moved past that, but given they're still struggling a bit, do you think they have a credibility problem?
Not at all. I think the Fed has done a really good job. So you have the economy growing, inflation has slowed down, full employment. So yeah, it may take a bit longer until they can cut rates, but at the end, it's not such a big deal because the economy is still growing. If I look at our own economists, so his expectation of growth, quarter in and quarter out, is been lower than what the economy has delivered. So I think that's why I don't believe that the Fed is in any hurry to cut here, because if they do cut and they do get it wrong, and then they have to overcorrect because of the lack of imbalances in the economy, that correction may be quite painful, and that most likely put inflation into recession. So I think in my view, the Fed have done they may have been at the beginning a bit late, but they caught up very well, and they're doing a very good job.
So what about the health of the global financial system? We're about a year or so after the regional banking crisis. JP Morgan bought a bank as part of some of those challenges that the industry was facing. We saw the capital injection into the New York Community Bank. Are we past this now, or because of some of the things we're still seeing in real estate and elsewhere, do you think there are still some problems ahead?
I think that we are so the banking segment overall, particularly the big banks, they were a solution to the problem and not adding to the problem. So the amount of liquidity and capitalization that we have, particularly the big banks, is perfectly fine. I think that the regional banks, though they have the challenge that they have in March last year, they are now, in my view, in a better place from the liquidity standpoint, on capitalization standpoint. They are going to have the challenge of more regulation. They were very lightly regulated. They are going to be a bit more regulated than they were. But the challenge there is not necessarily liquidity or not. Like the New York Community Bank is a good example that they have some issues, but they were liquid. They have enough long-term liquidity for the amount of non-guaranteed deposits they got. So that's why they didn't need the FDIC to participate or anything like that, and they find a private solution. The problem with that segment of banks, in my view, is more about business model than particularly a risk of liquidity in the short term. And over time, most likely you are going to see more combinations, more mergers of those banks. At the moment, it's not happening because there are not mark-to-market embedded losses into their balance sheet, that if you were to acquire one of those banks, you need to crystallize that loss and increase capital. So I think that the United States have over 4,000 banks, probably needs few less than that. So I think that it will be consolidation over time.
Well, would JP Morgan be a buyer again for any of these banks outside of a crisis FDIC orchestrated situation?
No, because it doesn't make any sense. We are in 48 states, so we are very embedded. We are quite relevant in most of the communities we operate. So for us, the strategy is organic, probably not in the banking sector, but it's small technology-related acquisitions here and there, but overall, we don't need acquisition. We have plenty of scale in everything we do, so we don't need any more than what we have.
Well, and possibly the regulatory environment outside a crisis situation may not welcome that kind of deal.
we don't need it, so we are not going to try.
Yeah, you're not going to push them up.
Very simple. So I think that First Republic deal was a good deal to stabilize the system, and an amazing company. I think that the risk management probably didn't go so well, but the franchise, the quality of the clients, the service model they got, it was amazing. We are incorporating some of what we learned by the acquisition to, for example, to change the model how we cover the more affluent clients. So I think that it was a great transaction for us, and most important, something that helped to stabilize the system at the time.
And going through sort of the geopolitical tensions that you've been talking to clients about, and whether it's China, whether it's the U.S. elections here, what are they most worried about? And for J.P. Morgan itself, or in terms of if there is another Trump presidency, any sort of trade wars reigniting, tensions with China possibly getting worse. I mean, we're already seeing the Biden administration talk about additional tariffs on China. We've obviously know that's also part of Trump's playbook. What are the concerns that you're seeing?
As a company like us that is global and very well diversified, we have gone through any kind of governments, right or left, anywhere in the world. So we are prepared for all these things. But clearly, the geopolitical environment is a bit more challenged than it was probably for the last 70 or 80 years. So you have the situation in the Middle East, Russia, Ukraine, the tensions between China and the US that hopefully is some way or the other compensated by dialogue. And when the dialogue between the countries and the recognition that the important commercial relationship between the two countries is at the forefront, the tension goes down. But it is something that you want to keep in mind as the confluence of the political cycle in the United States and geopolitics going forward.
Yeah, well, and we've seen investors in China and elsewhere basically vote with their capital, and seeing where the flows are going. In particular with China, where are you seeing that money moving, if it's moving outside of the country?
The bulk of it? Yeah. Of course.
Despite all the tensions.
Despite all the tensions, but not necessarily it's Chinese money. There is money that was invested there and is finding the way into some other places, but mainly the United States. So there is a bit going to Mexico, a bit going to China, to India, some of the Southeast Asia countries. But still, when you look at the bulk of the money is coming to the United States. I think that places like India has a great opportunity, but they have a lot of challenges. It's a very bureaucratic place. They haven't invested enough in infrastructure. So for the China plus one policy to be relevant to them, it will require a lot of investments in Mexico, in India, in many places around the world.
Yeah, well, for India, they are trying to take advantage of this situation where they want to be an alternative to China. What do you think they could do to sort of make that atmosphere more hospitable?
When you think about India, so you have service sector that has been growing a lot. We have more than 60,000 people there, great technologies, amazing. So, and that is a sector that they have seen the benefit over the years of the growth in India. The government has spent quite a bit of money, rightly so, into the bottom end of the basic needs of the bottom end of the population. What they haven't done, the challenge in India is the more middle part, so the generation of blue-collar jobs. That is being kind of stagnating over a long period of time. And I think that it will require a lot of investment, changing regulation to allow foreign investment going there. It will happen. There is a priority of the government, sure it will happen. You go to India, I was there very recently, and you see that the place is really booming. But still the amount of dollar coming of investment as a diversification of China is not yet happening.
And where do you see risks in credit, particularly private credit? We heard John Waldren, your counterpart at Goldman Sachs earlier, talk about this credit cycle and when it ends, we might find some things that we don't like. Where do you see the risk, particularly as it moves, outside the traditional banking system, and what regulators can't see there?
So I think that private credit specifically is roughly $1.5 trillion as a class. It's probably a bit over $1 trillion funded, the rest is unfunded. So I think that the amount of systemic risk that imposes, in my view, is very small, at least for now. So the risk that I see is more for the future than the present, because you don't find a lot of leverage in the space. And these funds, they are very well funded. They are 7 years lock-up money with loans that they are rolling in. These are 2-year loans or 3-year loans. So it's very unlikely they're going to have, at this amount of leverage, a systemic issue coming from that. Where I do see the risk is these funds are returning around 10, 12%, very attractive. So we see a wall of money coming into that space.
So LPs are going there, sovereign wealth funds,
Everyone is going there. So what is the risk? The risk is that as the amount of funding goes up, they have to find the loans to lend. So most likely, credit conditions will deteriorate, covenants will deteriorate, and most likely they are going to have to add, margins will compress, they will have to add more and more leverage. So as they become bigger, most likely they will become bigger and riskier. Issue number one. Issue number two, very, very important, is how these funds are going to behave when the economy does get into recession. For us as a bank, so our interest, because we have this sort of franchise relationship with all these, from small business to big corporations, so banks are a bit more benign in the way that helping the clients, because we have the benefit of, we do payments, we do capital markets, we do lending, we do many things with those clients. These funds, they have a fiduciary responsibility with their investors. So how they are going to behave, it may be perfectly fine or not.
Who do they choose?
Well, they will choose their investors. They have to. So what is the impact on those, particularly small business, in a recessionary scenario is yet to be seen. Because all this is being grown in a very benign environment of constant growth. And when it was a complicated situation with COVID, it was all subsidized by the programs of the government. So you didn't really have a tough recession to prove the model. So I am concerned about these two things in the medium term.
So I was just going to ask, where do you see that time horizon?
Well, the next few years, as the economy, let's assume that we are right and the soft landing happens and recession gets postponed for the next 3 or 4 years, at some point it will be a recession, and then the model will have to be proven.
Yeah. Well, we're almost out of time. I just wanted to ask you, since we are talking about geopolitical tensions and the elections and everything, what's your bet on seeing Jamie Dimon as Treasury Secretary at some point? Do you see that in the cards?
I hope he does. No, it's Jamie has been so fantastic for this company, but I think that he's someone that has so much value to add in any position. So I think the probabilities are very, very low, I would have thought.
Yeah, I don't know if he'd want to report to anyone else in that scenario. So thank you so much, Daniel. We'll if that happens, we'll bring you back to rate how he's doing.
Okay. Nice to see you.
Thank you.
Please welcome Lael Brainerd, Director of the White House National Economic Council, and Phil Mattingly, Chief Domestic Correspondent for CNN.
Good afternoon, everybody. Just briefly, I don't work for Semafor, which I've realized is an outlier, but I am a devout reader of all things Semafor, so I feel like I can be part of the team today. I'm thrilled to be able to chat with Lael Brainerd, of the National Economic Council. There's been some news this week, and that's where I want to start, because I learned very late we only had 15 minutes, so I had to scrap like 46 questions that I'd prepared. On tariffs, you and the president announced yesterday that you're calling for tripling of steel and aluminum tariffs on China. I was listening to the background call from senior administration officials, and there were a lot of details as to the why and the scale of the market and trying to get in front of what China's been doing. But there's also a statement that I was struck by where somebody said, this has absolutely nothing to do with the election, one of the officials said. That was said while the president was in the middle of a 3-day swing in Pennsylvania, where he was about to go to Pittsburgh to do an event at U.S. Steel. At the same time, the campaign launched a TV advertisement that started with an individual saying, I'm a steel worker. So this isn't about the campaign at all.
Look, I think what we all can see in the data is China is taking out its old playbook and planning to run again a recovery playbook based on dumping exports of manufacturers on world markets. And that's simply unacceptable. And President Biden is very clear. He wants a stable relationship with China. We have a lot of important issues that we're working on with China, but that he's going to stand up for American workers and the investments that we are making here in America in clean steel and manufacturing and industries of the future. And he wants to make sure that China's industrial overcapacity and unfair trade practices do not again lead to disinvestment and loss of jobs in U.S. manufacturing.
So the location in a swing state of where you and the president were and the campaign stuff was just coincidence?
So I think what's important, obviously, is that we have a very large number of steel facilities in Pennsylvania, as well as other states, as well as steel workers, in many cases multi-generational families of steel workers. American steel is among the cleanest steel in the world. It's very important to all the infrastructure investments that the president has secured in the bipartisan infrastructure law. And it's critically important that there be a fair playing field and that China not again run its old export dumping industrial overcapacity playbook. So wherever he is, the president's policy is very clear. He wants fair competition with China and will stand against unfair trade.
One more on the topic, and then I want to broaden it out on the general economy. But the president also yesterday reiterated his opposition to Nippon Steel's takeover effort. Guaranteed, I think he said, I guarantee, when somebody asked him if he could keep U.S. Steel inside the United States. I'm blissfully not a CFIUS expert, but to those that are, almost everybody I've talked to said this deal in any other time would not have any problem getting through the CFIUS process. Japan is a very, very close ally, particularly of this administration. I think you were at the state dinner last week. It feels very political, where the president, and I remember when your statement first came out announcing the opposition or problems with it, I was pretty surprised.
Yeah, Japan is a very important ally, and of course we welcome foreign direct investment from Japan, from so many other countries. In fact, I think we've got more foreign direct investment coming into the U.S. This past year than ever, and we welcome that. But steel is an industry that has very important national security considerations, very important economic security considerations. It is critical to supply chain resilience, and the president is very clear that he thinks U.S. Steel should remain domestically owned and domestically operated. And he has said that very clearly. He has told the steel workers that he knows that is important to them. And I can't really be any clearer than that in terms of his position on this.
Oh yeah, no, it's been there's a lot of clarity to it. I think the question is the expectation, because he has that position, that CFIUS must do something to block the deal?
So obviously there are certain legal processes that you're referring to CFIUS. Those are going to proceed as normal, presumably. But I think the president's statement kind of stands on its own.
To the broader economy, I want to run through some things first, and what I'm basically trying to do is front run all of your quick answers to my questions. Job growth continuing to smash expectations. Unemployment rate below 4% for the 26th straight month. Wage growth running tangibly above inflation. LFPR popped last month. Inflation 5.5% to 6% below where it was at its peak in 22. Biggest combination of legislative wins, I think, in the first 2 years that the president's had in decades. In isolation, most of the policies in those actually poll quite well, 55, 65%. Median income, I think Americans received on average about $7,000 in direct payments through the American Rescue Plan. Consumer spending has remained robust. People don't seem to see it. When they poll about their individual standing financially, they seem fairly okay. Everybody else seems to think the US economy is terrible. What's your theory of the case as to why?
Yeah, so, well, first, I think you're right. I mean, the IMF said it yesterday. A survey of Wall Street Journal economists said it 2 days ago. The U.S. economy under President Biden is outperforming any other country that is its peer, and certainly all expectations. Nonetheless, I think American consumers continue to see costs that are too high, and the president believes that we have made progress, but there is work to do. And he's working very hard to lower costs. Costs in areas like prescription drugs, where Americans can see that their prescriptions cost them 3 to 4 times what they cost in other countries, and that's why the important provisions, $35 a month insulin, capped out-of-pocket costs that he got in the Inflation Reduction Act,
right,
incredibly important.
But that gets to a point, though, because
let me just say one other thing. You know, as I look at those, here we are. The recovery is great. Wages are moderating. Inflation is coming down. Costs have come down. If you look at the PPI, input costs have come down. You know, the one thing that really just is at historically elevated levels and hasn't budged is corporate margins. And I think that is really important as consumers are becoming more price sensitive. That's where competition is supposed to work, in bringing those margins down and passing on those savings to consumers. And we're going to keep hammering on that point because it is really important that consumers get the benefits of the normalization of supply chains we've all worked so hard on.
To your point, you know, on prescription drugs, that's something that polls like 80%. You've been with the president on Air Force One, traveling with him the last couple of days. I know, having covered him, his frustration about him not seeing that people understand what you guys have done or not getting a better sense of things. Take people behind the scenes. When you're with the president, going to economic events in his home state of Pennsylvania, what's he saying? What's he telling you? Is he frustrated? Is he trying to find new ways to deliver a message that lands?
Yeah, so I will, it's a great question. So he sat down with small business owners in Allentown, Pennsylvania not too long ago, the Vargases. They opened up a coffee shop as the president came into office. And their coffee shop is thriving along with the main street of Allentown. And what they took him through, I think, is exactly what he is seeing in so many of his kitchen table conversations. they explained how having the ability to get health care through the ACA, the child care tax credit, the help to small businesses, the investments that are coming through Clean Energy, Inflation Reduction Act, the infrastructure investments, all of those things are coming together to create a small business boom in Allentown, and also to make it possible for people like the Vargases to actually have the means to start a small business that is now thriving. So when he sits at kitchen tables around the country, people talk how important the president's policies on bringing down prescription drugs, on supporting. I mean, we are seeing more small businesses starting up than we've ever seen before. How all those policies come together and make a real difference in their lives. But they do say that affordability of prescription drugs remains a problem. Housing remains a problem. The tax system isn't fair. And that's where you see his policies and his budget really prioritizing those areas.
And I assume, true to form, when the president has those meetings or reads something that catches his eye, he often turns to his staff and says, we need to do something about this?
The president is very focused on the things that are raised in these conversations. And that's one of the reasons that you saw the biggest housing plan in a generation. I think that's what a lot of housing experts called it in his budget. That was reflecting directly what he was hearing from the people that he's meeting out in the communities around the country.
Gas prices were an obsession and a focus for past iterations of this White House staff. I know you guys are also very key on it as well. John Podesta earlier this week was asked if tapping into the SPR again was an option as gas prices start to trickle up, obviously a lot of volatility. He didn't say no. Are you actively considering actions related to gas prices, SPR included right now?
Yeah, so of course, gas prices are so important for American families. It is, for many American families, a weekly purchase. It is a price that really matters to their monthly budgets. And so we're very focused on it. Gas prices have come down about $1.60 since their peak. But we're going to stay focused. This is the time of year when the gasoline mix changes. Yep. And so we're keeping a very close eye on gas prices at the pump, and also, of course, some of the events in the Middle East. There's geostrategic risk, and we'll continue to monitor. There are, of course, things that have been done in the past, and we'll continue to very closely monitor, make sure that gas prices remain affordable for so many American families going into the summer driving season.
So nothing imminent, but nothing's off the table.
Carefully monitoring.
You mentioned the volatility. I'm a huge fan of watching the VIX to understand Wall Street sphere gauge, to understand where people are in the markets right now. I think it hit a 6-year peak a couple of days ago, given everything that happened with Israel and Iran. Should people be freaking out right now because of the geopolitical issues that you're talking about?
Look, I think we have a number of geostrategic risks. That's always true. And of course, this president has literally decades of experience on the world stage and is actively engaged. I think he's very focused on the speaker's move forward with funding that's so critical for Ukraine, as well as more broadly on the foreign policy front. But we'll continue to monitor. And I think, in areas like Red Sea, the supply chains are just much more resilient. We've seen shippers taking alternative routes. We really haven't seen that becoming an issue in terms of costs, but we'll continue to monitor.
Connecting it to the gas price issue, I think 2 days ago, you slapped sanctions back on Venezuela for not living up to their end of the deal. Iran sanctions were announced this morning by the Treasury Department in collaboration with allies. Oil sanctions were not included in this initial tranche. The president said that they will keep coming. Should we expect oil sanctions on Iran?
Look, I think what you saw this morning, I think, is kind of the information that we can provide to date. But again, we're highly attentive to the international oil markets and domestic gas prices. We'll continue to monitor closely and want to make sure that those gas prices remain in current ranges as we go into the summer driving.
And do those domestic gas price concerns carry more weight in the decision of sanctions?
So obviously, a complicated set of decisions on the foreign policy side that make that really determine those outcomes. And of course, I can't go into any particular considerations. Well, you're very kind, but
safe space.
But I think those are, of course, they are very important tools for national security purposes.
More broadly, I mentioned the legislative agenda, and the president has made very clear implementation was a huge focus of the 2 years that followed, and I'm sure will be a huge focus in the second term, should he win in November. But given the fact that there's an election, how cognizant is your team as the West Wing about getting regs out the door, getting rulemakings out the door, just in case the president doesn't have a second term?
So I think in general, all of the administration's leadership has been working as rapidly as they can to make sure that regulations have all of the necessary public comment, that the public comment is taken very seriously, but also to provide certainty for the broader business community and the broader economy to get them finalized, to get them out the door so people are able to make decisions with certainty about what those regulatory guardrails are going to be. So yes, I think there is right now a lot of ongoing attention to finalizing rulemaking, but that has been true throughout the Biden administration.
Is there extra urgency with like a clock to January 20th at 11:59 a.m.?
Each of the regulations has its own clock because it's very important that we gather public commentary from all stakeholders. So each of our regulations is on its own clock, and that's determined by the independent agencies or agency leadership.
I'm trying to get you there. You're not coming with me. I know how the rulemaking process works. No, it's certainly been a focus for you guys. Kind of on that point, though, you talk to campaign officials, and they acknowledge the pressure of this moment. There's pressure going into any presidential election or re-election campaign, but the stakes given who he's running against. I'm not trying to get you to do a Hatch Act violation, but you guys feel that too? Like this feels different, that this moment feels different. The stakes feel enormous right now. And on the economic team, your ability to get the message to land, to make sure people understand the policies, is that much more important given who the president's running against?
Well, we do think that the president's plan is a smart plan. It's a plan that will grow the economy in a way that is good for the middle class, that's good for business, good for working families in America. So the stakes are enormous. The president has very much focused on making sure that we have investments in industries of the future, and those go along with good jobs, so clean energy, areas like leading edge semiconductors, where we've seen the first investments literally in decades, as well as in family-sustaining jobs, infrastructure for the first time. But he also is working hard to make sure that our tax system is fair, that it gives a break to the middle class and asks large corporations and the wealthy to pay their fair share. So there's an enormous amount on the line here. Whether you see a tax plan that goes into effect that actually reduces the deficit by $3 trillion over the next 10 years, which is what the president has put in his budget, or whether you see a tax plan that blows a hole in the deficit by $5 trillion, which is what we saw in the Republican Study Committee's budget. So there's a lot on the line, preserving Social Security and Medicare, paying for it with a fair tax system, and growing the economy from the middle out and the bottom up.
I'm out of time, but I'm going to squeeze one last in because I've got the microphone. Were the tariffs a response to Trump directly?
So again, I think what we are seeing in China is the increased emphasis on exporting its way to recovery rather than relying on its own consumers threatens a potential flood of unfairly priced exports into other countries, and President Biden is not going to let that happen, and that is why he announced that he wants to see tariffs increase on steel from China.
So no, this was not a Trump thing? Lil Brainerd, very busy. Thank you very much for your time. Thank you guys, everybody.
Please welcome Semafor co-founder and editor-in-chief, Ben Smith.
People just start leaving when I stand up. But anyway, we are about to break for lunch. Thank you so much. Thanks to Bank of America for making these great interviews and possible. Thank you to the speakers, to Phil for moonlighting for that great interview. And hope you will come back this afternoon for a really amazing set of conversations on AI, which will include Stefan Bancel, the CEO of Moderna, White House officials. Should be extremely interesting. We have excellent sandwiches out there. I have tried all of them. Hope you will come back.